Haschak, would you lead us in the Pledge of Allegiance?
Stand. Ready? I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Okay, the Mendocino County Board of Retirement meeting for February 9th, 2025 is called to order at 8:30. Judy, can you take the roll call, please?
Yes, Mr. Kelly?
Here.
Ms. Cavanis? Here. Mr. Cromer?
Here.
Mr. Shoemaker?
Here.
Ms. Harris? Here. Mr. Swope?
Here.
Ms. Pierce? Here. And Mr. Land?
Here.
Thank you.
Okay, item number 1 is the swearing in of John Haschak, 3rd District Supervisor appointed by the County Board of Supervisors. And we'll stand. I will read. Okay, repeat after me. I, John Haschak, do solemnly swear that I will support and defend the Constitution of the United States and the Constitution of the State of California against all enemies, foreign and domestic. That I will bear true faith and allegiance to the Constitution of the United States and the Constitution of the State of California. That I take this obligation freely without any mental reservation or purpose of evasion, and that I will faithfully discharge the duties upon which I am about to enter. I hereby attest that as a member of the Mendocino County Employees Retirement Association Board of Retirement, I will carry out my duties and responsibilities with respect to MCSERA in accordance with the highest fiduciary standards and in compliance with the laws, regulations, and policies applicable to MCSERA.
I do.
Okay, we got a signed copy. And then I sign this, I believe. And I believe I hand this to you. Okay. All right, on to item number 2, consent agenda. All matters on the consent agenda are to be approved by one action without discussion unless a board member requests separate action on a specific item. Does any trustee wish to pull an item from consent for discussion? Seeing none, is there any public comment? None. The consent agenda is approved by unanimous consent. Which brings us to item number 3, discussion and possible action regarding approval of cost of living adjustments as of April 1st, 2025. Doris Rentschler, Executive Director.
Thank you, Chair Land. In your board packets is the calculation of the 2025 cost of living adjustment done by our actuary, Siegel. And there is a 2.5% inflation for those retirees that have a COLA bank. They will receive the full 3% COLA effective April 1st.
Do we have any board discussion at this time? No? Okay, is there any public comment? And I have to say that I've been informed that there is. And please state your name for the record. You have 5 minutes to address the board.
My name's John Almeida, and I'm a retiree from Mendocino County. This is my yearly trip down here to see you folks. And the reason I come down here is because I believe this retirement is very important to everyone. I think everybody should be coming here. To thank you for the hard work that you do, to show appreciation for the need we have for this retirement. Like I've said in the past, I watched my father work in logging until he was in his 70s and he died because he couldn't live on Social Security. And when I came to work for the county, there was 2 things I wanted to accomplish, and one is improve the road system, which I believe we did a lot during that time. And the second was to have a retirement that I could live on, because I know Social Security alone is very hard to live on. So I want to thank everyone for the work that they do, the hard work. I don't come down here that often, but I watch you guys on your meetings every once in a while, and I come down here once a year to show my appreciation for what all you do. And Please keep up the good work. I know we're in tough times. Make conscious, conservative investments. That's all that I ask. Thank you so much. We all depend on this retirement that worked here. Thank you.
Thank you.
Thank you.
Okay, so at this point, we need to I need to ask for a motion to approve or not approve.
Approval of the goals for 2025, April 1. Second.
Is there any further discussion by the board? Okay, Judy, roll call, please.
Mr. Kelly,
Yes.
Ms. Cavanis,
Yes.
Mr. Haschak,
Yes.
Mr. Cromer,
Aye.
Mr. Shoemaker,
Aye.
Ms. Harris,
Aye.
Ms. Pierce,
Aye.
and Mr. Land.
Aye.
Approved.
Okay, on to item number 4, Historical Benefit Review Project Status Report and Project Updates. Doris Rentschler, Executive Director.
Thank you, Chair Land. In this month's report for the correction project, it does reflect the completion of several corrections. They are primarily revisions that were already reported, which is why there's no additional count associated with them. These were DRO revisions where the alternate payee was given the opportunity to receive a reduced life benefit. So that wraps up that correction item for the board. At this point, there were still 50 corrections outstanding. We do have a request in for an extension with the Internal Revenue Service that, upon approval, would grant us until, I believe, July 6th to complete the remaining ones. And if you have any questions regarding the project, I'm happy to answer those at this time.
Any concerns about completing it in the next 5 months, 4 months?
I believe we would be able to do that. The remaining corrections are on the more complex side and involve a variety of interlacing issues, which is why in some instances they were held. Most of them were held at one point because they had purchase issues that we're waiting to see if the IRS would accept our proposal. But we feel that we can complete the remainder before the July deadline, and overtime has been authorized for completion of this project.
Are we working on the first extension now?
The first extension associated with this compliance statement, yes.
Do we have any further board discussion on this item? Is there any public comment?
There is no public comment.
Okay, seeing none, we move on to item number 5, Investment Matters. At this point, I'll turn it over to Greg DeForest and Claire Tellen from Callan. Introductory comments.
Thanks, Robert. And good morning. Great to see you all. Thanks for having us. It's nice to be back here at 625 Kings Court. All right, so the first thing up on the agenda today is interviewing emerging markets equity managers. But there are 2 things that Callan will be covering today in terms of investment matters. The first is, supporting your interviews of emerging market equity managers. And then, of course, we'll be covering performance after that. So a snapshot of performance as of the end of the calendar year. So those are the 2 things you'll hear from us on today. We will get to the interviews here pretty quickly. Robert's arranged those. But before we do, we thought we would spend a minute as just, on reminding ourselves, how did we get here? What's the goal today? Where does this fit into the total portfolio? So as a reminder, last year, we took a look at the total non-US equity portfolio, reviewed the existing structure, and decided to make a couple changes. So ultimately, you as a board decided to move forward with moving about 63% of the total international portfolio to a core index fund. And then employing your active risk budget with your emerging market equity managers and your international small cap managers. So the result of that decision was that we have a couple new mandates. So at the end of last year, Callan did 3 searches to help implement that new structure. The first was for a passive core index manager. Again, that'll be the bulk of the new international equity structure. And then the other 2 searches were for one emerging markets manager to complement your existing emerging markets manager 91. And then we did a second active search for an international small cap manager to complement existing manager T. Rowe Price. At the last meeting in December, we reviewed those searches, selected an index manager. So that piece is selected, and then agreed to interview 2 of the emerging markets managers and all 3 of the international small cap managers, finalists that were discussed. So starting today, we're looking at the emerging markets managers. At the next meeting, we'll be interviewing international small cap managers. So today is focused on emerging markets. On the page here, we've depicted at the bottom the current structure of the international equity portfolio, and then the new structure, what we're moving to. So circled there on the right pie chart is the mandate that we're looking to identify a manager for today. So it'll be about 13.5% of the total international equity structure. And again, this is an emerging markets manager to complement existing manager 91. You'll hear from 2 firms today. The first is Artisan, and the second is RBC. RBC stands for Royal Bank of Canada, as a reminder. So this is the investment arm of Royal Bank of Canada. And individuals from each firm will be here to present in person. I believe there'll be 2 individuals from Artisan, and then 1 in person from RBC, and 2 in person from RBC, and 1 virtual. The portfolio manager will be virtual. As a reminder to what we talked about at the last meeting, here we have, again, just a snapshot of each of the 2 firms and the fees that they've proposed for this mandate. So a couple things when we think about both of these firms that you're going to hear from. The first, most importantly, we think they're both good choices. So we've gone through a thorough process, weeding down the entire universe of potential options to get to these 2, and we think that they're both good choices. We also think they're both good complements to 91. So there's not a bad choice on the page. The fees proposed for each are here. Each manager will talk about their team, their strategy, and have their individual fee proposals. Artisan has proposed a fee for what they call their founders tier share class of the collective trust, 65 basis points. RBC's all-in proposed fee is 84 basis points. Those are both reasonable. So, when we look at those fees compared to the fees for other emerging markets managers, strategies, we do think they're both reasonable. A slight difference between the 2, but for context, your existing manager 91, the fee is about 80 basis points. So all within the same kind of range. The other thing to keep in mind from the fee perspective is that in moving to this new structure with the index fund and then taking your active risk budget with emerging markets managers and international small cap, the total fees for the international equity structure will go down meaningfully regardless of who you pick for this slot, and same with the international small cap. So a couple things to keep in mind there. And then on the following slides, we've refreshed information on each of the 2 candidates. We'll let them speak to their team, their process, their strategy. But again, just as a reminder, we've got Artisan and we've got RBC. Both firms implement their portfolio as fundamental portfolios. So they're picking and evaluating stocks, building their portfolio from the stock level, from the bottom up. RBC, a little bit different than Artisan, is also looking at themes. So you'll expect to hear about that from them. So they think about their portfolio from the top down, looking at themes from a sector perspective, from a country perspective, and then identifying stocks that they think will benefit from those themes to build the portfolio. Artisan is led by a key portfolio manager, supported by a team of 6 dedicated analysts. RBC is a multi-PM structure. led by one individual who you will hear from today, and then supported by 3 dedicated analysts. So slightly different team structures, but somewhat similar there. Both portfolios are relatively concentrated. Artisan portfolio holds about 55 to 80 names. RBC, a little bit more concentrated, 45 to 65 names. And then both from kind of a style perspective, again, tend to plot pretty core, but Artisan, you'll note, has a bit of a growth tilt to it. As I mentioned at the beginning, we think both are good complements to 91. One more thing I wanted to mention that is escaping me now, but I think those are kind of the key things that you can expect to hear from each manager. Again, we think both are good complements and both would fit well into the total portfolio structure. Yes.
Your chart, there's a column product.
Yes. Sorry, what was the question on that? There's the product and vehicle.
Define for what is a product AUM.
Gotcha. So the product AUM is going to be assets under management for the strategy, the total strategy. There's different vehicle access to the same strategy. So, might be a mutual fund and a collective trust, different share classes of collective trusts, separate accounts. So different access to the same strategy. The specific vehicle under consideration, so the pooled fund that you would be investing in, that's the vehicle assets under management.
You define the terms.
Can I define it?
For us.
Sure. So when I think about bottom up versus top down is kind of looking at the portfolio from a top down level. So I would say RBC, as I mentioned, they're identifying themes from a top level and then picking stocks. That's the bottom up part, identifying stocks to build the portfolio from the bottom up. Artisan is more focused just on that bottom up piece. So picking stocks individually to build the portfolio, whereas RBC has that kind of top down overlay. That help? We've refreshed performance, comparative performance for the 2 strategies on pages 7 and 8. Both strategies have done well over time and in the last year as well. One thing to note in RBC's performance is they've tended to protect well on the downside. So you'll see that come through in their performance. You can see it in the calendar year performance on page 8. Particularly 2022, RBC was down almost 14%, but they protected really well on the downside versus the benchmark and versus peers. So that's kind of an interesting component to their performance pattern. They may not keep up as much on the upside. At least that's what we've seen in the last 10 years, but they have protected on the downside. Again, both of these performance patterns have led to very strong 5 and 10-year results. Are there any other questions on the 2 managers or kind of what we're looking for before I turn it to Robert and we start to hear from the 2 firms?
Okay, thank you. And are we ready with our Artisan Partners presentation at this point? Okay, Robert?
Let me go grab them.
Hey, how are you? Nice to meet you. Morning, everyone.
Okay.
I was going to say, I have hard copies if anyone needs one. Otherwise, yeah, no problem. Do you guys need a hard copy?
I'll just leave this one on here. This one's on. Be able to. Everybody have a.
Well, I'll take one.
You want to?
Sure. Appreciate it. Forward, back. I'll
Okay,
try to
perfect. Yeah,
anticipate what
yeah.
you're,
Okay.
where you're going. I
Sounds
could be
good.
wrong.
Okay, great. Good. Well, first of all, thank you so much for letting us present to you today. It's great to be here. Really appreciate the opportunity and your time and interest. For introductions, I'm joined today by Maria Negrete Grusin. Maria is our founding and lead portfolio manager for the Artisan Sustainable Emerging Markets team. My name is Sean McCoy. I've been at Artisan for about 8 years. Been a number of years doing manager research. The first manager I ever visited was actually Maria when she joined Artisan in 2006. I spent a few years working at 91, and I joined Artisan in December 2016. So before we begin with the prepared remarks, I was just going to say, first of all, we really understand the importance of today's meeting and why we're here. Returns for your stakeholders, obviously the members, extremely important. My wife actually worked for a Connecticut municipality for almost 20 years in Connecticut, where we live. So she's a pension beneficiary. So we very much understand the importance of family individuals making future decisions based on the assumptions that are taken in these meetings and the decisions made today. And we've also been, following the minutes and understand what you're aiming to do in your non-U.S. equity portfolio. And we're obviously a little bit biased being emerging market managers, but we think EM is certainly a great place to find inefficient opportunities and generate some good returns. So we'll spend some time talking about that. So we'll flip to page 4. So I'll just spend a couple minutes talking about Artisan and what I think sort of defines our culture, and really we'll spend most of the time with Maria. So Artisan, we were founded in 1994, so just over 30 years. We have 160 billion in assets under management. But I think what's unique about us are 3 things. It's our focus, our resources, and our alignment of interests. So when I say focus, while we're a large firm, we have 160 billion in assets under management. There's 11 investment teams on this page. We have over 500 employees, 70 of them are here in California, actually. But we really believe in laser-focused, distraction-free investing. So what that means is Maria and our 6 analysts spend 100% of their time on this strategy. They have no other responsibilities except for managing the assets in this strategy. And we think that's important because we don't want them to be, sort of worrying about managing a business and, managing too many people. So we don't meet with the other investment teams at our firm. We don't have different flavors of EM. We don't have different EM strategies. Sustainable EM is all that we do. Secondly, in terms of the resources, that's really where Artisan comes in. And they're there to provide whatever it is that Maria and the analysts need to do their job well. So a travel budget to go meet these companies in emerging markets, customized software solutions, data subscriptions, people, back office, all those things Artisan is there to provide. And lastly, in terms of alignment of interests, Maria, the analyst, myself, we're all equity owners in Artisan, but importantly, we invest in this strategy. The analyst compensation is tied to the alpha generated in this strategy, 1, 3, 5 since inception. So we're alongside our clients in this. And then we'll spend time talking about capacity, but I think that's really important. We manage just under 2 billion in this strategy, but we want to keep the assets low. The goal is to have single-digit billion capacity. Why? Because we'll talk about the differentiated names we own. We want to be able to own those for you in the future. We don't want to get so big that we're not able to go into some of those smaller names. So it's that combination, focus, resources, alignment of interest, that really has led to us having a very stable, tenured team, but also a really repeatable process. Any questions on the firm? Okay. So just quickly on page 5, I put together a timeline to try to give you a visualization, probably tougher on the screen to see. But really the story here is, Maria and the analysts started this strategy in October of 1999 at DuPont Capital Management. They joined Artisan in April of 2006. So we have a really long history of managing emerging markets assets, and we've seen a lot of volatility in that time. Maria and the analysts have lived through a lot of different markets. And what that has led to is lessons learned, right? There's obviously been periods of weaker performance. There's been periods of better performance. But importantly, we've enhanced our tools and our process accordingly. And I think the most notable enhancements really took place in 2014. We enhanced our country risk assessment to make it really more customized on a country-by-country basis. And then we introduced a sustainability assessment. We'll talk about both of those, but those went into place over 10 years ago. So with that, I think I'll turn it to Maria on page 6, introduce the team and philosophy process, but please do jump in with questions as we go.
Great. Well, thank you for the opportunity. And for my time today, I'm going to talk about the team, who we are, which I think is the right place to start, talk about our process, and leave enough time to talk about the positioning. Where do we see the opportunity in emerging markets today? So the 3 things that I like to highlight in this page about the team is, first is experience. We have been doing this for a long time. I think I don't want to say the days, not to date anybody, but it's been many, many years. And I think this experience really have come from having been invested in emerging markets since they first became investable, meaning that we were in the first public offerings of some of these markets when they were really in the very early stages. So that is one sort of experience. And also for who we are as a team. Every member of this team, with the exception of Megan, as me, is born, raised, and partly educated in emerging markets. So we don't look at EM as something over there that is tactical, that you get in and out. We are committed to emerging markets. We are committed to the people of EM. This is what we're doing. We don't see this sort of big difference between us. That intimate knowledge and passion for emerging markets is really what drives us in our team. The second point to address about our team is continuity. We have a long history of continuously investing in emerging markets. And truly has been a roller coaster of market conditions, what we have experienced. So that, as Sean alluded to, had brought us perhaps sometimes painful moments, but at the same time incorporated these painful moments into the tools that we use today. How we pick stocks today is not the same way we did it 5 or 10 years ago. These lessons learned have made our process stronger and our tools that we use more accurate in predicting the different environments, either from the country, from the stock specific. And that is something we believe we bring to the table. This is not a process that is frozen in time. This is a process that is dynamic and responding as emerging markets to the realities of today. The final point to highlight about the team is communication, how we operate, how we work. I'm the portfolio manager, so I'm the final decision maker, but this is not a PM-centric strategy. The alpha, the power of the strategy really comes from the analysts. They are the ones who drive the idea generation. They are the ones who have the ownership and accountability for those ideas. People sometimes ask me, how come you managed to have such a stable team over the years? We have very, very low turnover. We have been together with Megan and myself for decades. The other analyst teams are many, many years. And the answer to that is because they have ownership. They have accountability over what they do. It's not that, I recommend a stock and Maria didn't like it. No. Think of me almost as a clearinghouse of all their ideas. My job is almost accommodate them in the portfolio with very set criteria. So I think that constant sort of communication makes us nimble. The team, as you can see in this page, is a small team, and we like to keep it that way because that is what allows us to be a true team. I don't want anything to get sort of lost on translation that I told this person, but the head of research did not. Every idea gets evaluated, discussed, I think, and acted on. And that is what we try to keep here, the nimble, dynamic nature of the team. If you have questions on the team, I answer them now. Otherwise, I move on to philosophy and process. Sure. Our philosophy also comes from the same history that I described. In all these years, what have we learned about emerging markets? So the 2 things we know that we knew back then when we first started and we know today is that there is growth in EM, and certainly we go there to get this growth. But also we know that it's going to be a very bumpy ride. That boom bust is the nature of the beast. So we don't tell ourselves stories that this time around is different, that they have graduated. No, this is what it is. There's growth, but it's going to be a lot of fragility. That's what makes them emerging markets. So how knowing these realities, what type of opportunities are we looking this in this environment? So first, certainly we want access to this growth, but we don't want what I call the one-day flowers of EM. I don't want the company that maybe is in the right place at the right time, but anything changes in their environment and the whole thing falls apart. So we want, yes, growth, but we want access to what we consider from this overall growth environment, what company can translate it into sustainable growth and sustainable earnings. This is where sustainability is important to us. It's not about capturing the 5 minutes. It's about what management, what company, what business can translate this into something sustainable. It's not the top line we're going for, it's the earnings, sustainable earning powers that we're trying to capture. The second reality is crisis, as I said. All our companies are exposed to that. So knowing that, we say, well, which of the companies that we're going to invest are going to survive the shock? So we're looking for a sustainable competitive advantage that is sustainable enough that would allow the companies to withstand the inevitable shock. And that is very important to us. What is the nature of this competitive advantage? Is that access to a resource, access to a technology? What makes this company be able to survive the volatility of their environment? So when we find a company that has one or both of these criteria, this is a company that is a starting point for us. This is a company where we can continue to do our work. In terms of sustainability is on our name, and so I have to often answer what does sustainability means to us. And I say to us, we take a very emerging markets approach to sustainability. We take a realistic approach, but also we believe that sustainability is not an adornment that we put in our companies. To us, it means endurance. It means the capacity to survive. And it means how these competitive advantages are defined, for example, has to be in the true sense, will this company be able to retain their capacity to operate? If a company believes that competitive advantage is abuse their employees and pay them very little, that might have worked for a period of time, but that is not sustainable. So we're not going to give them the credit of that, or destroying the environment. That is not sustainable. And that, for us, is not about exclusionary, and it's not necessarily the definition of perhaps in the developed world. It's what is necessary for companies in the environment where they are to withstand and to be able to be there the next day. So moving on from there, 2 pages. Maybe I'll skip that for the interest of time, and I'll go straight into the process. So the goal of our process is among these companies to have this unique access to growth or this sustainable competitive advantage. Which of those are undervalued relative to their sustainable earnings? So the heart of our process is really the company. At the company level, what is the true earning power that this company has? So we go very deep, and that's where myself and the analysts requires a lot of engagement, a lot of traveling to these places. I say we have to kiss many frogs to come up with the prince. And this process of kissing frogs, I mean, tonight I'm going to Korea, and that's typically, and I'm going to meet there Gupri, which is our Korea analyst that is there already, and we're going to meet dozens of companies. Of those dozen frogs, maybe 1 or 2 of those might make it into the portfolio at some point in the future. So the earning powers, assessment of earning power is really at the center of what we do. This normalized ROE, as we define it, or 2-point ROE story. So what we're hearing is looking for margin, turnover, and leverage. What are the levels that this company can sustain? Historically, we look at all the financial analysis of history, so we don't make excuses for EM companies. A lot of people say, oh, in EM, the data is bad. If the data is bad, we don't invest. We need to have the history of these companies and understand it. And we do a very long forecast. We do a 5-year forecast of everything, income statement, balance sheet, and cash flow. This is quite sort of in-depth analysis of these companies, because we are not looking at them as a trade, as a getting in and out. We really need to understand them as a going concern. And that is what it takes. Really look at the historic. We do a 5-year forecast. Together with that, we do what we call a business analysis. It's more about understanding the environment and the quality of the industry where the company competes. In emerging markets, it's often if you're a supermarket in northern part of Mexico and Walmart is going to be right next to you, well, no matter how good you are, your life is going to change. So this type of dynamics are more industry dynamics, and then we bring that into the table as well. So together with the environment and financial analysis, we have the earning power. What is the true earning power this company has? The next step of the process is what are we prepared to pay for these opportunities. So the valuation country is very important. So although we are a bottom-up manager and we're looking for stocks, in emerging markets, you cannot ignore the importance of country risk. So country risk, and given our long history in this asset class, we have had the opportunity to refine how we look at country risk. So the way we do it is not a beauty contest. We're not trying to find, these are the good countries or these are the bad countries. We believe in emerging markets that changes places very rapidly. So where we're looking is comparing these countries versus their own history. Are they improving or deteriorating? And we penalize at the stock level. If you are operating in a country which country risk is impactful negatively to your business, we need to be very punitive in your valuation. And that is how country risk touches valuation. It's not a country allocation tool, it's a risk mitigation tool. So our country risk, we take it as pure risk and we penalize it at the stock level. I can, if you have questions, go more in detail, but it's quite, as Sean said, we have evolved over the years. We are now backtest each factor specific to each country as identifying the best predictor of negative outcomes. So not every country in emerging markets has the same factor. Yes.
I would like to venture back in time a little bit to, I think it especially affected the Asia, the collapse of Lehman Brothers. And could you tell some of the dynamics around your analysis during that time?
Yes. When we look at this as an example, there have been many others. I mean, the Asia financial crisis, for example, there was a complete implosion, or the connection with the developed markets and emerging markets. We have in each part of the world, and picking up in Asia, for example, what are the best predictor of negative outcomes? Something like current account to GDP, or real exchange rate over valuation. These are factors that we are taking the history, all of the history, and saying, well, how this company has behaved and what has been the outcome to that. So current account to GDP, for example, is an indicator that is very telling of predictor of crisis. And this is what we're pushing. When we look at periods like that, what it starts alerting. We're looking at this, a picture, if we can go to the, we have this in page 12. If you look what matters, here we have Brazil and we have Korea. So as this is at a point in time, this is at a period in time. But I have the perspective of this data over time. So when this red starts getting redder and it starts moving, means that you are moving 1 or 2 standard deviations away from your historical average. The way to look at this, if everything is in my normal scenario, which is not perfect, I'm on a 3. When things start moving into the red, this is a very alarming moment. And then you need to see, how do I penalize the stocks further? And that is what happened during that time period. You see emerging markets started becoming more vulnerable. And this is sort of an alarm bell to us in terms of how to avoid or how to penalize our valuations for what is happening here. And I think these factors, as you can see, Korea and Brazil don't have the same factors. We learned this, again, the painful way through history, that you need to know what are the best predictors at the country level. In Brazil, for example, inflation acceleration, hugely problematic for the countries in Latin America, a lot less so for the ones in Asia. So this is kind of the division, and during every crisis you always come, it's like, what are the new ways that we can capture? The limitation, and I will tell you right away of this, is that the availability of the data is something. If we need historic data, we need the data to be there. So that's what I always are revising. Are these the right indicators? Because as more data becomes captured and is available, it's more important, it's more helpful to us. So moving on to like the final step in terms of valuation. So we have our earning power, we have a country risk assessment, and we have our sustainability assessment, and that is in the previous page. So our sustainability assessment really is one of the parts of the process that has evolved a great deal over the years. Historically, we were mostly governance-minded. I mean, governance is always important. We're minority investors. We're investing in very different places around the world, so we need to know that our investments are protected, that our rights as minority shareholders are respected. So that's at the center of it all. But over the years, we say, well, environmental and social also very relevant to these companies, kind of preserving the right to operate in the communities where they operate. So rather than taking, we did in the past take third-party vendors and people that sell sustainability data, we have gone and done it ourselves. We are very heavy on engagement. We travel to these places very often. So our score is based on twofold. 50% of our score is based on incidents. Incidents is an oil spill or an accusation of sex harassment. We are measuring this over time, and we're not being naive to try to find the perfect company in EM, the company that has no blemish. We know in EM, a lot of companies have a lot of skeletons in the closet. So we say we just want to take them out and say what they are and see how the reality of these incidents have moved over time. A company that had 30 incidents 3 years ago and now only has 3. We can measure progress. And these incidents, this is not coming from the company. This is coming from third-party, international media, local media, and NGOs, looking and monitoring these companies over time. The other 50% of the score is our own assessment of what is important in this market, our materiality assessment. We create our own questionnaires, and we answer them when we meet the companies, and we often do this. So really verifying that this company is consistent to the way they operate. All this score goes into a multiplier that is applied to our price target. So maybe with an example, I wrap it up in page. We have, it's to a Greek bank.
14.
Page 14.
14. Yep.
Just to give you the basis of, this is an example of a Greek bank that we have owned in the portfolio for quite some time, Alpha Bank. I think when we look at this competitive advantage, unique access to growth that I talk about, Greece is an interesting example because Greece is a country that went through the most massive crisis, right? The economy collapsed, a big financial crisis, really GDP contraction multiple years. So you say, oh, why are you talking about growth in a place that really has done anything but growth? But even in environments like that, what we see out of this debacle of the Greek crisis came up institutions that kind of were born again in a way. They after all these bad debts and all the environment, they create an opportunity of recapitalized fresh banks addressing a population that was quite impoverished by the crisis, but it was ready to kind of reinvigorate. I mean, today I think Greece is one of the most dynamic economies in Europe after this terrible moment that they suffered during the crisis. So when we look at the unique access to growth, the competitive advantage, we see an experienced management that has gone through a lot, that is now has an opportunity to regrow again. Very interesting. So the sustainable earnings in the right side is 13%. So this is not a spectacular growth company. This is not like a write home about, but that's okay for us as long as we deem that that is sustainable. And we accompany that with a multiple of 6 times that takes into account the Greek country risk that, as I say, Greece went through the wars. It was all red, and you can see it's moderating and going in the right side as the macroeconomic and other parts of the economy are much better managed like that. So I put next to that a sustainability assessment of 4. This company is in the highest standards of governance in all the aspects of their business, and that gives me an upside of 73.8%. This is what guides me into say whether the stock makes it or not in the portfolio. So the construction of the portfolio, the buy discipline and the sell discipline is all about what we find at the stock selection, right? So we say, well, in this process, we have incorporated country, we have incorporated sector. We're not thematic. We're not trying to say, let's find Mediterranean banks. No, this is, the stock makes it in because in its own merits, even in a convoluted space, it deserves to be in the portfolio after we incorporate that, and it has sufficient upside. So our construction really is that stock level. The sell discipline is the other side of this buy discipline. Why do we sell a stock? Because it reached the price target. That is a happy way. Or the unhappy way is because something had to change in the sustainability, in the country risk, in the earnings power that make the stock no longer be compelling. So that is what creates a dynamic. And finally, the output of this in page 16. Our portfolio, as I say, we typically own 60, 70 names. And this is all about the names that we find in the portfolio that have the greatest upside. In terms of market capitalization, as you can see on the top left of the slide, we don't discriminate. I mean, meaning if there is a very large cap name that is amazing and that has a lot of upside, great. But typically we find ourselves where you see us in this page, overweight on the mid, overweight on the small. This is not a deliberate tilt of the portfolio. This is more, in emerging markets, the most exciting stories in EM are these new industries, are these new areas of EM, and they generally at the beginning, at least in the origins, are smaller. But it's not by design to get to that in terms of capitalization. Very importantly, there on the bottom right side, the pie side, that is another sort of uniqueness about our strategy. About 40% of our stocks are not in the index. You might know the emerging market index that people use and we measure against is MSCI. I do have a lot of objections to that index. It's a China-centric, top-heavy index. And we don't think that that is truly the opportunity in emerging markets. If you look at the index, it assumes that it's like China and India and a handful of other things. The reality is EM, the true EM that we're looking for, the authentic EM opportunities, live in places like Greece, live in places sort of outside. And a bit of the disappointment around emerging markets over time has been like that definition that is the BRICS, the big countries with the big population. That is part of it, but that is not necessarily what EM is. EM lives in these places where our capital is valued, where we come and we can add value and differentiation with the proper allocation of capital. And that is across many geographies, not necessarily kind of narrow to this index definition. So when we go on these 40% of the names that are not in the index, it's not the obscure corners of emerging markets, not obscure at all. These are the true emerging markets. And I think our process, our history, our discipline allow us to identify opportunities there, and that's where we have historically added value. Many of these names are in EM countries, meaning are in places like Mexico, Brazil, that are just not frontier countries, very small exposure through frontier, but it is on places that are truly emerging markets. One of our largest names in the portfolio today, the largest overweight, is Mercado Libre, which is an e-commerce company. Argentinian by birth, I call them, because their business is mostly the rest of Latin America, a champion in e-commerce with the highest sort of returns and quality of delivery of any e-commerce company, even globally, and is from a country that is not even in the index. Argentina is in no index because it's kicked out for bad behavior out of everywhere. But this company is the opposite. I mean, when I look at country risk and how this company, the business is primarily Brazil, Mexico. So this sort of distinction of the country domicile is something that we don't believe. We're looking for true EM exposure in areas where the qualities we're looking for, this unique access to growth, this competitive advantage can present. So the other final point to make in this chart is our country allocation, fully consequence of the stock selection. As I hope I elaborated, our country allocation is not meant to be a tool, it's meant to be a risk mitigator.
How often have you had to adjust or modify your predictors for
all of them in a monthly basis? We're looking at different ones. In the country-wise, monthly indicators change. On the sustainability part, every week, every Thursday, we get a new incident report. And that is very important, that dynamic nature. The idea that EM is static and what worked a year ago still works is not true. So I think that is what is important, to have this nimbleness of the tools that you use. That's an important lesson learned from us. And then,
Maria, sorry.
Yeah, I'm curious about your incident report. What would make up an incident?
we look for severity, but an incident, I mean, the good part of that is that we are not being the judge of that. We have hired a firm, it's a Canadian Swiss firm, that does sort of risk for most insurance type clients, but we buy that data and we create our own incidents. So anything that is reported negatively about a company, imagine this is a big data gather of only bad news. Anything that is reported in a local newspaper about this company being accused, and many times I meet with the companies and they're like, Maria, fake news, that's an employee that we fired that is all angry about us. I'm like, somebody's taking the time to hate on you that much, you are doing something wrong. So yes, we're not making the judgment on if it's, relevant, no, it's certainly severity, but we are capturing news from all sort of negative news, for obviously international media, local media, and anything NGOs put out there. So imagine a big data gather of that. And we have the opportunity to open the hood and go to the company and say, well, we don't want to talk to you about all things you're doing sustainability. How are you handling this incident? And that's where the company has the capacity to say, like, it's not true. Well, many times, yes, this happened, and this is what we're doing to correct what's happening. Because if you neglect these things, it's not only that companies are behaving, but the consumer ultimately will respond to that. The business, the community that they sell to respond to that. It becomes very relevant.
Yeah, I would just add, so this is coming from RepRisk as the data provider. It's a good example where Artisan can really help the team basically create a monitor that allows us to just see the data summarized. We don't have an analyst keeping track of this in an Excel spreadsheet, but we can really create a very professional, sleek monitor that gives the analyst the output, and then as Maria said, if they want to dive down, they can go see the individual RepRisk reports, and then on the other side, the analysts are filling in their own questions. So these incidents would typically be things that are exterior to their business model. Like, for instance, if it was the Greek bank, an incident that would be like a bad investment that they made, would that count as an incident?
If it's something like, for example, a non-performing loan, that would be more in the part of our business, right? This would be on the earnings assessment of the company. But if it's them being accused of malpractice or not, that will become as an incident, right? So that's why we're trying to capture the part that if we don't do that specifically, we might miss it. This is not, oh, this is bad loan, it's impacting your quarterly earnings. We'll know that in our earnings analysis. This is more about this company is accused of discrimination or anything in terms of bad loans that could become very impactful in their ability to license, to continue to operate, that might not be visible in the earnings pattern. So we're trying to capture both sides of it.
I'll use China as an example, though, as I say, you are not focused necessarily on China per se. I had fellow grad students who would marvel, well, I do my research, I can just present it as my research. But in China, if it goes contrary to the government line, you look at your data again and reevaluate. So in those type of environments, how do you handle the official line type of countries?
Yeah, in terms of, there are a couple of aspects. You can see here in the chart, China is certainly our largest underweight in our portfolio, and it has been that way forever. It's structural. And what is that? Why are we underweight China in this way? Why don't we own? It's very important. We don't own the state-owned apparatus. Why? Because it's like if you look at a Chinese bank, their earnings are complete fiction. That is something that we cannot. As I say, the data is not there. We cannot believe this. So we will walk away from that. So these are not companies, really. They are ministries of the state. That's not true to say that all Chinese companies operate in that way, no, and that's what the stock selection help us sift through that and go to the company that, even in that difficult environment, which China certainly is, can create a business that it has a true basis, that can operate really despite this pressure of the state. But that keeps us away from many. In terms of the data for our country risk assessment, for example, macro, that's what is important to test different factors, because GDP, it's again manipulated data, so we need to find other sources of data that are better suited to kind of predict what is the real economic climate than the ones that come from the States. So we kind of vote with our feet and walk away from things that we think are not real opportunities because the transparency or the clarity of the data is not there.
How quickly would you be able to walk away from investments in China or Taiwan, which obviously are in the news now, and how would you factor in the change in our government with regards to Ukraine, and how it would impact the safety of certain emerging markets?
Yeah, we are very careful on liquidity and ability to exit. I think that is very, very critical. How we own the stocks, where the domiciles are, how can we exit? And maintaining liquidity of the portfolio is very important. In terms of us ability to position ourselves for these changes or the geopolitics of today, which impacts, I don't know, Mexico, US regarding tariffs or anything that is happening in the Middle East or with the war in Ukraine. These are factors that are very much impactful, not only at the country's risk level, but the stock-specific level. I think these are something that today, when the election happened, given the high, at least 50-50 chance that it was going to be the case, we needed to already be away for what I call the first line of fire. We cannot be in a stock that is very much dependent on that, let's call cross-border or bilateral situation. We cannot be there, and then we protect the portfolio that way. There are second and third derivatives of what is happening. That will impact us anyway, and that's how we have to. But the defense of the portfolio, when these very binary outcomes are out there, we have to defend the portfolio. I think that is sort of the best. But that is not to say that we are they're not going to be third and fourth derivative consequences of these acts. I mean, the end of the wars, both in the Middle East and Ukraine, I think not only for humanity's sake, but for all of us, it will be a very good outcome. How do they end? That is the question. And in what terms, and what happens to a country like Poland, for example, in this, and how are we positioned to predict that? We cannot predict those events, but we can position the portfolio to protect from the worst scenarios. And that, again, we have been there for the situation in Russia. Russia was an emerging market, so we have learned that, again, by fire. I wanted to finish on the country, 2 seconds. We talk about China as an underweight. I always want to highlight the overweights in places like Argentina and Vietnam, not to say, well, these places, people say, oh, those are the scary ones. I argue that they're all scary. You just have to properly penalize them, and where the stock opportunities there really, after you have incorporated the country and so specific factors, they present the greatest upside, and that is where we should be. The true emerging markets, our non-benchmark exposure is something that to many people is more risk. To me, is a diversifier, a risk mitigator. Our latest stock, can I talk about something about this here? Is a Slovenian bank. And Slovenia it couldn't be more marginal, right? It's a tiny. But this bank is what it's doing is acquiring banks in the Balkans, former Yugoslavia, creating a very basic bank with tremendous growth opportunities as the larger European banks leave these countries because they're marginal to them, and they can create a true growth opportunity, trading at with 15% ROEs, with single-digit multiples, 80% upside. Megan found the stock in Europe. They came to see me in New York 2 weeks ago. Great opportunity. That is the true emerging markets, and that's what we're trying to capture. To me, the Slovenian bank, relative to the index, we say, oh, that's more tracking error. No, this bank is very uncorrelated, a diversifier, a risk mitigator in our mind.
Any questions on position? I was going to quickly touch on performance, but any other questions on position would be helpful?
You've referenced the pie chart on the bottom of 16 numerous times, Maria, and do you think that's something that's unique with your company?
Yes.
I'm getting the impression that you do, and I haven't talked to the other companies yet. So why do you choose to have 40% not in index? And I think you've referenced it a few times. And why do other companies not do that?
I think, I don't know what other companies behave. In our case, why we do it is because we're looking for the true EM opportunities. And we believe that the index in this sort of China and top-heavy almost is constrained to almost the history of what was the past of emerging market, and ignores the true nature of what is an emerging market opportunity.
Yeah, I mean, I look at some of our peers, and I do think this is a big differentiator for us. We tend to have more small cap exposure than most of our peers. So out of these 23 names, 8 of them you would find in the all cap benchmark because they're considered small cap. But then, as Maria said, 11 of these names, they trade in MSCI EM countries, but they're just newer industries that the index hasn't uncovered. So it's giving you the opportunity to get in a little bit earlier to an industry or a company that other investors haven't recognized. So there's a little bit of an opportunity there that we see. And then, as Maria said, we look at EM quite broadly through our travels. So we have some countries included that are considered frontier markets. But to us, we're not aiming to say we need to have this many small cap, this many frontier, but they're companies to us that really help comprise a great portfolio of
Vietnam, for example,
Yeah.
is considered a frontier until I think they're going to be included next week. I don't know, very soon. So to us, we have been going to Vietnam. The experience of the team, the extensive travel that we do is what makes us have the comfort that these places are not obscure to us. We understand them. We can be there. We have been there over the years. That is what gives us the comfort to go to places like. No, we do, but it's considered frontier. But I think MSCI or the index is doing a revision, and it's going to become EM. To us, we have already been invested there, but it certainly is good news because more investors are going to look at it. So great.
So mostly in things like banks? Or
No, everything.
So I was going to say, I think that ties well into performance because typically a third to half of our alpha comes from those off-benchmark names. And because they're not in the benchmark and many of the names we own are very small in the benchmark, we're able to add strong returns on top of that. So quickly on pages 17 and 18, these are annualized returns. I updated it through January, but you have December in there, so you have an apples-to-apples comparison. I think the more important page is on page 19. So if you take a look on a calendar year basis here, what I think is really important is the consistency of our returns. So we're one of the few managers to be able to outperform in 9 out of the last 10 calendar years. When I look at the broad all-cap universe, which is over 300 strategies, I think there's only 8 strategies, including us, that have been able to outperform in at least 9 calendar years. So it's a very consistent return string here. And what that means is you have 4 down markets on the page, 6 up markets. We've outperformed in the majority of those. It includes growth, value. So a lot of different market environments. And why that's important is because over 10 years, we're top quartile. We've had a very strong return string over that time frame. And the last slide I wanted to show you quickly on page 20 is looking again at the last 10 years. I've broken it up into rising and falling markets. So there's 3 falling markets and 3 rising markets. So a lot of times people talk about down market capture, up market capture. When we look at EM, as Maria said, we're going to EM for the growth. You're going there for the returns. So I think what's important is in 2 of the 3 down markets, we still perform pretty well, better than most peers, maybe not as good as everyone else, but pretty good. The up markets, we've done extremely well. And even if you take that weakest down market period, which includes 2022, which was a weaker year for us, we followed that up with a very strong 23 and a positive 24, which is great. So when you look at the entire picture and the return string, I think when you take into account these rising and falling markets, you'll see stronger returns coming from us in those up markets. That's because these companies we buy, they're sustainable companies. They may feel some of that initial shock when there's a market change, but because they're companies, they last after the dust settles. They're some of the companies that perform the best when things start normalizing. So when you look at it in the whole picture, I think when you look at us, we're going to look a little bit growthier than your current manager, but that makes for a very good complement. We're going to tend to do better in the up market. So, in summary, I think the 3 things that are really unique about us is the portfolio composition, and as you described, it's those off-benchmark names. Those really allow us to add significant alpha in these time periods. It's the consistency of returns, and I think really importantly, it's the focus for our team. We wake up every morning, Maria, the analyst, myself, all we do is work on this strategy. So this is what we think about first. We're not worried about any other strategies. So any other questions, happy to answer them.
Just out of curiosity,
Yeah.
when did you invest in Taiwan Semiconductor? When did you first?
It's decades since we own TSMC.
Yeah.
It's a champion, that
It's
one.
one of our best contributors since inception, for sure.
So you obviously worked at 91 before.
Yes.
And can you talk more about why you think that this firm is so complementary to 91? Because we're staying with 91.
Yes,
We've
I
decided
understand that.
So,
Yep.
Can you talk more about that?
Yeah, I mean, I don't want to comment too much on another firm, but from our standpoint, I think when you look at our portfolio, we have a little bit more small cap exposure. We're going to look a little bit growthier. Callan's obviously a great consultant. Whoever they brought to you are going to be good options. But I think when you look at us on the year-over-year basis, we tend to perform, we have a lower correlation to 91 than most peers. and will look a little bit growthier. So I'd expect to see them in sort of the middle of the chart. We're going to be a little bit further out in growth. We're going to come down a little bit. We'll have a little bit more small cap exposure. So our portfolio, and over a 10-year time period, is a great complement. We actually have one other client that has the same complement of us in 91. It's worked out well for them.
Just as far as the tariff wars that are starting,
Yes.
and it just seems like emerging markets would be at a higher risk.
Yep.
So what's your strategy to deal with what it looks like is going to happen?
I think the inevitability of some tariffs, we don't know what the dimension of that, and if it's going to be 25% or 15%. This is something that has been heavily kind of telegraphed to us in emerging markets. And then we go at the top level and then at the bottom level, at the specific level. What companies are going to be impacted by that directly? The company that is very export dependent, very direct bilateral trade, well, this is a company that is going to have an impact. But what we have seen already taking place is the redirection of trade. It's not necessarily that trade will stop and these items will not go anywhere. It's like this redirection of trade and how our companies are positioned for that. Our Mexican portfolio today, what do we own? It's a stock like Cemex. Cemex is a cement producer in Mexico that has exactly what the administration wants. The operations in the U.S. are U.S. operations, fully U.S. operations, and that is not impacted. No cement is going from Mexico to the U.S. The U.S. operation is in the U.S., the Mexican operation is in Mexico. This is a company that the first whip, Mexico, and the stock goes down. This is a great opportunity. Last week, the stock was up 13% in one day as people start to realize that this company actually is very well positioned for the growth of infrastructure that's happening. This is one of our Mexican names. I mean, another Mexican name that we have is Entera. It's a low-income bank. What they lend is to mostly women in the most poorest, vulnerable segment of the population. You say, well, this bank is not impacted by the level of rates. This is almost a sub-economy that is taking place in Mexico, and this bank has managed to create a model very specific to that. That is our exposure in Mexico. What we don't have in Mexico today, that we used to have previous to this tariff war, is a company exposed to the near border, the near shoring, all the maquila. That is, in our mind, not an opportunity at this point. Maybe it will present in the future. So we can position the portfolio. They're not all losers in this tariff situation. There are winners and losers, and we have to position the portfolio to the companies that not only can almost withstand the shock, but that potentially can benefit, like Cemex as an example. As a reduction of import cement, or price of cement goes up, that this will be a winner in that environment.
So part of your, I'm looking at page 10, I've got
Yes.
it up there. Part of your process is doing a 5-year forecast, and we've had a lot of questions over the past couple of years about time periods.
Yeah.
Why not forecast 7 years? Why not forecast 3 years? Why not forecast 1 year?
Yeah.
Can you talk about how you think about the 5-year and why that is important?
Yeah, the 5-year forecast with people sometimes make fun of me because they say 5 years is an eternity in emerging markets. Like next year, everything is going to be completely different. But the point of the 5-year is that we want to try to capture sort of a cycle, a full. Given that we're looking at history, many times our companies will have very long history. Sometimes they don't. They're younger companies. So we want to capture at least this 10-year period to get to see how this company in a normalized earning powers behave. We know that is a tenure for us, a typical tenure. We have low turnover, is about 3 years, but some companies like TSMC we have owned for decades. But these 5 years allow us to have a big observation, even if we're not going to be accurate. The point of our forecast is not that I'm going to tell you our EPS today, I know what's going to be 5 years from now, the same. No, but we want to understand and have the discussion with management. It's not in what's happening next quarter. Is what are your plans for this longer term time period? Are you going to reinvest your capital? In what way? What are your leverage going to be if you continue to grow at this level? That 5 years gives us a better sort of full cycle of economy for in the context of EM, but also a better discussion with the management, which is a big part of our process. When we engage with management, it's not, oh, are you going to beat the next quarter? It's not like a sell side analyst is writing a report that has to be very accurate. What we need to capture here is the more longer term, how the management really thinks about the business in a more long-term basis. But it's considered to be a very long time framework in the context of EM.
May or may not be willing to divulge, but over time, what do you think was your most important lesson of sort of learning lesson moment?
There have been so many. We'll have to there have been maybe some of the ones who have culminated. We had a difficult year in 2011, bad performance year. And the easy answer would have been to say, oh, the market was this and we're that. And that is sort of the first place where you go, oh, it's like the market is wrong and I'm right. But then when you go dig deeper, what were we doing wrong? That we missed some things. And I think here is where we say a lot of the things that seem almost superficial or unrelated to the earning power tend up being very important. A company that is a public company that is not ready to behave as a public company when some moment of crisis comes. And I think that is why you need to be very systematic about penalizing the companies at this level. And that is what we started when we started quantifying. It's not only about earnings, it's all about little scoring governance, on scoring in sustainability and relationship to the company. All these things are equally important in the context of emerging markets. This is not about doing good or bad. This is about having a business and running it responsibly in an environment where you know it's inevitably going to change. So this 2011 painful performance period was a big sort of soul search for us in the same, like we cannot just implicitly think that we look at these factors and no. We have to explicitly look at this and have the discussion with management every time and ask the question every time. Engagement is not only about what is your business going and how you're going to reinvest your cash flows. It's about how are you behaving regarding these things? How are you responding to these other pressures? So that was a difficult period, but there have been many others in specific instances. But the 2011 negative performance was a big one for us because we had to kind of dig deeper in what really we did wrong.
And that's what drove those enhancements I talked about in 2014 were really sort of lessons learned coming out of that difficult performance period and moving the country factors were the same for every country prior to that. 2014, we realized they really had to be specific to each country. And on the sustainability assessment, a couple of the companies that were weak performers in 2011, they weren't very good at their disclosure or their communication. So that's why we started scoring from a governance standpoint on items like that and really understanding the company behavior. So, as Maria said, we've had a lot of experience out there, but those two enhancements really were in relation to that.
I have another question, just briefly.
Sure.
Talking about the cell discipline on page 15, can you give us a sense, just broadly, kind of out of these three options? Usually, is there one that's happening more often than another?
We hope it's the top one.
Yeah. I mean,
in reality, the second, the more often one is a company might not almost make it to the price target, and we sell it when the upside is lesser because another opportunity comes along the way. The analysts generate 4 new write-ups per quarter. And that doesn't seem like a lot, but this is a very in-depth sort of analysis. So the analyst comes with a new recommendation, and we don't want to proliferate the portfolio. Otherwise, we have like 1,000 names, right? So every idea has to compete with the rest of the ideas in the portfolio. And that is ultimately my job. Like, your name is great. We love it. It has 50% upside, and I'm going to say, love it too, but it's not enough today. Because of the situation in emerging markets, you have to compete with a portfolio that has 70% upside. So how much upside is at any given point? But that is the most often situation, is that another name that have marginally more upside comes out, your name gets out. That is a bit of what happens. Also happens that we have to change our assumptions and the story that we expected to be great. Walk away, cut your losses is also very important. It's a big lesson learned. You cannot assume, no, I believe it was 50% ROE and 20 times multiple, and I'm not going to change that. No, it's no longer that. We were wrong, and we have to reevaluate, and the stock gets out. I would say the replacement is the most typical.
And to be fair, I know you guys have talked about it, but the ultimate decision is you.
Yes.
every time.
Yep, exactly.
Are there any other checks and balances that are in place other than the analysts you've talked about, or just being honest with yourself and realizing when you need to cut your losses, or realizing when you were misled or may have misinterpreted something?
And it's not in that part of me as the final decision. Yes, it's ultimate, but this discussion happens. We have 4 meetings per week. So we meet in because we travel very extensively. So we don't get to be in one room at the same time. So we meet 4 times per week, and we had a meeting this morning. And every analyst talks about their ideas, what they're working on, and how the stocks are behaving in the portfolio. Indeed, at that moment, the rest of the analysts in the team all have an opportunity to inject themselves. So I said the decision is never done by conflict, but I feel this way. It's all by this almost talking these ideas to death. And like all the discussion, everybody had the opportunity at the end. It feels very natural. It feels this is where, like an analyst has a stock that has a great upside and they've been talking about it. The other analyst almost in the meeting tells me, oh, that sounds like a good replacement for my stock that only has 20% upside. And I would say, yeah, sure. So that is how I'm the final decision maker, rather than me kind of pitching to analysts against each other, or me saying like, this is what I like. It's not I like one stock, write me by recommendations to the things I like. It's all the opposite. It's really the analyst generating the idea and me almost clearing house to say, well, there are these names, oh, the analyst has more upside than the other stock. This seems like a good turnover idea. But yes, in terms of organization, the analysts generate the ideas, they presented it in an ongoing basis. The rest of the team gets to participate in this discussion. And ultimately, the upside is what decides whether a name makes it or not in the portfolio, not whether I like it.
Okay.
So my question involves succession planning, because you are so deeply involved with the decisions that the portfolio holds. What steps or process do you have in place for succession planning?
We had in many periods in which I've been absent, Megan and Chen, which are the other senior members of the team, have taken over, and they co-manage the portfolio, and that has happened in the past several times. In terms, that is what it almost implicitly is the succession. Both of them are as experienced and as knowledgeable in the overall portfolio. But I would argue that when we look at somebody like Gupri, which is in charge of our implementation, she's a younger analyst, she arrived later, is the person that every approval, everything goes through her. Another person very intimately related with the ins and out of the portfolio, very close to every transaction that we do. But in the past, and what is official is Megan and Chen would co-manage the portfolio, and they have done it before.
And I think it's also worth just noting that, you know, there are mechanisms in place where Maria has to give a significant amount of notice to Artisan, and she has compensation tied to leaving as a good citizen and so forth. So if Maria decided tomorrow she doesn't want to do this anymore, there's a multi-year plan to, she wouldn't just not show up. So.
I like doing this.
Yeah.
So
Of course.
I don't have any hobbies or anything.
Yeah.
And I raised my children and I worked. And now my children have brain brace. So now I like to do it. I sometimes say, if I wasn't paid, I would still do it.
The Chevron question. You and Megan don't travel on the same aircraft, right?
Well, usually we meet there. We don't often travel. We might have in our past at some point, but no, it's been a long time since we don't do that.
Do you have a question?
I do.
Yeah. Okay.
Sure. Are your analysts compensated by performance?
Yes.
And do they have the best performing analysts carry a little bit more weight on the next meeting?
Yeah, they're compensated by performance, but I'm also a believer that the best performing analyst doesn't mean anything in terms of every member of this team at some point has had their highest highs and has had sort of difficult periods in performance. I think that commitment to the process, to what we do, it is also important to us. The majority of their compensation, it is performance. We have 4 different time periods. It's inception, so they carry their entire history, 3 years, 5 years, and 1 year. And we split these time frames, and that's how most of the compensation, but I also reserve a part of the compensation, smaller though, to the contributions to the team. meaning contribution is we have an internship program every summer. We get 2 interns, which are great, and they help us in revising our ESG question, doing many things. And who of the analysts takes care of the interns works. And I mean, I always tell the interns, this is not an internship that leads into a job, but they don't believe me because Nicolas was an intern, Gopri was an intern, Javier was an intern at some point. And I think it's the best program to really have somebody test them in the actual work. And if we ever intend to grow the team, that's the source of. But there is also that contribution to the team overall that gets rewarded.
Any other questions?
I guess on the investment fee, they're all comparable. From I'm sure you guys know what other players are doing.
Yep.
But yours is lower.
Yes.
Than the one we have now and the other competition we're talking to today.
Sure.
Is that intentional, or how is that investment management fee set?
Yeah, so if you look on our page here, page 21, so what you're able to invest in is a founder share class. So the vehicle that you're investing in has about 250 million in total assets. We wanted to set some founder share classes to get it up to about 300 million, where it's a little bit more scalable, where the operational costs don't run as high. So to incentivize clients to come in, we have a lower fee that you're able to get, which is 65 all in. As you can see, the standard fee will be 90. So this is more just to incentivize some of the earlier adopters into this vehicle.
And ours would stay at the founder?
Yeah, you would always be at the founder. Future contributions would always be at the founder's level. If your assets went lower, you would always be at the founder's level. You're 65 all in for good.
Understood.
Yep. Any other questions? I want to be respectful of your time. I know you have a busy day, but happy to answer any questions.
I have one from the back, and
Sure.
this is kind of more of an academic.
Yeah.
Hi, Sean. It's good to see you. Maria, so good to see you. Kind of more of an academic question, and kind of in the news sort of thing. But it appears that the current administration is being a little more receptive to Russia.
Yeah.
I think there are a lot of legacy Russia holdings in certain funds, and I don't know what happened with all of that.
Yeah.
What happens to the previous exposures
So for
if there's an opening?
Yeah, so for us,
We'll
we
be
were
only one
actually
stock.
we were actually just able to sell a couple of the Russian names we had because actually to one of the earlier questions, what would you do about Taiwan and China? We own things locally, so we were actually able to sell those. Basically over the last couple of years. There's still one name that has been sanctioned that we cannot sell, which is Sberbank. So that is in the fund. So if things were to open up and we could sell it, Maria and the analysts and the traders would talk, and if it's an attractive price, they would sell it. The reality is that this vehicle was at a lower asset base when we own those names. So it's somewhat diluted now. It wouldn't really impact stuff too much.
Is that something the EM community is talking about now? Like what happens if Russia opens back up? All these legacy securities that were written down.
I think the reality is that the experience that we have had with all the conflicts is that the conflict might end, the sanctions don't necessarily go away.
Yeah.
So that will be a much longer time frame. So to try to assign value to that is premature at this point.
Yeah.
I think a lot of people are stocked. I mean, in our case, it's only one stock that will be, and it will be relatively marginal, the potential positive impact. Of course, I think we should celebrate the end of that conflict for humanity's sake, but in terms of the impact is relatively minimum, and the experience is that sanctions might be in place years and years after the conflict ends.
Okay, thank you.
Any other questions? I'll just take a minute to really say thanks. We obviously appreciate all your time. We were here with you for almost an hour, so appreciate that. But we really appreciate the opportunity to work with you. You'd be a very important client for us. I hope you think about us. Again, I think the composition of the portfolio is a great complement to what you have. That consistency of performance over the calendar years, I think, is important. And again, I think you should rest assured that every day we wake up thinking about just this one strategy. And we'd really appreciate the opportunity to work with you guys, and hope to speak with you soon. So thank you.
Thank you for all your questions. You
Yes.
made it. I didn't have to sit here and do a monologue, which is really great.
Always better.
I appreciate all the questions. Thank you.
Thanks, everyone. Thank you. Okay, at this point, that was quite a bit of information. Would everybody like to take maybe 10-minute break before we start in with the Royal Bank of Canada? Yeah?
Yeah.
Would, you would? Okay, let's take a 10-minute break. It's come back at 5 after 10, I guess it would be. Boy, I need my glasses more and more.
Share yours.
Thank you. Okay. Next on the agenda is RBC Global Asset Management, if everybody is ready. Emerging Market Equity Presentations, and Tracy Monroe.
Good morning,
Yes, be
everybody.
Tracy.
Thank you so much for having us. It's beautiful up here. I'm Tracy Monroe. I'm considered one of the relationship managers. So I go and, hang out with him when I can at the SACRS conferences. I'm here with two colleagues, Alyssa Howard. Alyssa is a product specialist. So she sits in the US with me because our team is based in London. And then we have the head of our emerging markets business, Phil Langham. He's based in London. He started with the firm in 2009. And he has built our emerging markets team since 2010. And he is the expert. He's built an amazing team and has been there since the beginning. And I think there are very few firms who have that kind of consistent track record with personnel as well as performance. RBC Global Asset Management is a division of the Royal Bank of Canada. We are somewhat separated from the larger organization because we have our own policies, and the investment teams themselves have autonomy in terms of how they express their particular strategies. Despite that, we have over $480 billion in assets under management. And in California in particular, where I live in Los Angeles, we have over 4,500 employees. And I'm proud to say that RBC has donated over $3 million to the victims of the recent fires in Los Angeles, which I'm happy to receive. And so the company itself is aligned with organizations in California, not only in terms of how many people we hire and support, but also in terms of how we express ourselves in the communities in which we live. And so I hope that you'll really get a chance to understand who we are, what our values are, and I think you'll enjoy learning more about our emerging market strategy. And with that, I'll just pass it over to Phil.
Great, thank you, Tracy. Good morning to all of you. I'm going to start with the team on slide 3. As Tracy mentioned, I joined RBC in 2009, so about 15 and a half years ago, to set up the emerging markets team. And before I joined, RBC didn't actually have an emerging markets team, so I started it from scratch. What attracted me to RBC was the culture, the process, the philosophy, the opportunity to grow my own team. But I'd say, above all, the level of commitment that was shown by senior management towards really wanting to grow in emerging markets, and that has very much turned out to be the case. What I've looked for in terms of building up the team has been to try and find people who are naturally intellectually curious, people who are humble, people who are focused on continuous improvement. But for me, the most important factor has been to find people who are team players. You can see that we're a very diversified team, diversified in terms of gender, background, experience. And for me, that's been really important in terms of how we work. I haven't wanted a bunch of people who'd be very similar to me, who would always agree with me. But this culture of lots of different views, lots of discussion, lots of debate, people challenging each other is really important in terms of how we work. Another key feature of our team, hopefully it'll be one that comes through as we go through this presentation, is that we have a real focus on research, and everybody in the team gets involved in research. Now, moving on to the philosophy. The philosophy very much comes from lessons that I've learned in the time I've been doing emerging markets. I started doing emerging markets 32 years ago when it was a really small asset class, just a handful of investors, a handful of companies, and I've seen it change to the very large asset class that we see now. And for me, the 3 most important lessons that I've learned are, first of all, the importance of management. Management that are driven to succeed, management that are entrepreneurial, management that can be trusted. And when I look back at the emerging market companies that have been really successful, it's very much those where management have really been able to distinguish themselves from competitors. The second factor for me would be the franchise. So a company may well have strong competitive advantages now, but will those advantages still be there in 5 years' time, in 10 years' time? And the third factor is durability. And really by this, what I mean is to what extent do companies really think about the future? Do they plan for the future? Do they have adequate infrastructure, adequate R&D? Do they really look to build long-term relationships with all their stakeholders? If you look at all three of these factors, they're all factors that lead to long-term value creation. And I found the best measure of value creation is cash flow return on investment, which really emphasizes the cash flow generating ability of companies. So our philosophy is to invest in those companies that have a sustainably high cash flow return on investment. Now, if we turn to the next slide, we can see a typical example of one of the holdings in our portfolio in the blue bars. That holding has been in our portfolio pretty much since the inception of the strategy. And that company is called Tata Consultancy Services, or TCS. It's India and emerging markets' largest IT services company. And you can see in the blue bars the very high cash flow return on investment returns that TCS has achieved, in contrast to the yellow, which is the benchmark. What we see over the long term is that these cash flow return on investment returns broadly equate to long-term earnings growth. Now, what is it about TCS that has allowed it to achieve these sustainably high returns? Well, we would point to a few different factors. So first of all, management. TCS is still family owned. It's owned by the Tata family. And they're a family that really do think long term. They think in decades. There's a very entrepreneurial culture. Decision making is decentralized. Essentially, employees are given targets and it's very much up to them how they achieve those targets. And there's a real focus on innovation and on keeping up with the latest technology. The business model itself is asset light and focused on high returns. And there are strong barriers to entry in terms of their technology, their scale, their brand, their reputation. We would also say that in an industry like this, the most important asset are your employees. And if you look at employee attrition at TCS, it's less than half of what it is in the rest of the sector. And that's because of the emphasis that they put on training and developing their employees, on engagement, on culture. Also, if you look at TCS's customers, every year, 90 to 95% of revenues come from existing customers. So there's a very high quality of earnings. Hopefully this gives you an illustration of the sorts of factors that we feel are really important and that we feel lead to these very high and sustainable returns. Now, turning to the next slide, in terms of our investment process, it starts with a top-down overlay. That top-down overlay is driven by long-term themes, and we broadly look for these themes to contribute 30% to returns and stock selection 70%. And if we turn to the next slide, you can see the themes that we have in the portfolio. So you can see that we've got domestic consumption, financialization, digitalization, health and wellness, and green infrastructure. And the important thing about these themes is that they really allow us to get away from the constraints of a benchmark, the sort of typical country and sector over and underweights. And from a top-down point of view, really position the portfolio in areas of long-term sustainable growth. So, for example, if we take health and wellness, what we see is that healthcare penetration in the US is 18% of GDP, but it's 5% in emerging markets. And the sort of trends that we see that are increasingly prevalent in developed markets, so trends such as lifestyle diseases like diabetes, or trends towards people spending more money on healthy food, on natural food, all these trends are increasingly prevalent in emerging markets too. Now with that, I'm going to hand over to Alyssa to spend a bit more time talking about our research and also the work that we do from a bottom-up point of view to get a stock into the portfolio.
Yeah, absolutely. Thanks, Phil. So on this slide, what you can really see in terms of our research process is what I'd qualify as our 4 pillars of our research process. So we're very long-term in nature. We find a lot of other market participants are focused on next quarter, next year, but what we find is the true value of a company is really determined on cash flows in the future, in the next 10, 20 years. So we take a very long-term perspective when we're investing in companies. We also like to take a very global approach. So using those themes that Phil just described really, again, helps us position the portfolio in areas of long-term global growth. We have a very strong emphasis on management, so as part of our investment philosophy, but as part of our investment process, we have to meet with management before we invest with a company, and we engage with them on an ongoing basis. So we'd like to take a bit more of an owner's perspective. So we'll engage in topics such as board diversity, executive pay, supply chain integrity, so really developing a strong relationship with management. And the final factor is ESG factors. And for us, it's very important to incorporate this when we're looking at companies from a bottoms-up point of view, because what we find is those companies that score well in terms of ESG tend to not cut corners. They tend to be thinking about the future. When we think about corporate governance in particular, that's very important when you're investing in an asset class like emerging markets. So in terms of the investment process itself, you can see on the next slide, we start with idea generation. I'd say a majority of our idea generation is actually coming from that thematic research that we're doing. The other half coming from the on-the-ground research that the team is doing in country, meeting with companies, suppliers, competitors, et cetera. And once we find a company that we want to do work on, we have a 4-step investment process. So the first is our initial company research, just trying to get an unbiased view of a company, looking at industry publications, annual reports, things like that. Again, just trying to get a better sense of the company and what they're really like. And this is important because we need to know a lot before we meet with the company in our second step. So that company meeting is when we're meeting with management. So we do a very detailed prep note in advance of meeting with management. Again, really focusing on long-term factors. What are your competitive advantages? How are they sustainable? How are you thinking about the future? Again, want to take that owner's perspective. We also like to get access to different layers of management. We meet with CEOs, but they've all heard our questions before. So it's really helpful for us to get access to different layers of management to really understand what a company's culture is like. If that goes well, we continue on to our next step, which is our buy note and valuation analysis. It's a great, very concise 1-page summary of the company, our valuation analysis, as well as our buy decision rationale. So it really helps us put pen to paper on why we want to own a company. And then the last step in the process is our investment checklist. And you can see on the next slide a bit of a snapshot of it. And it really is the most important step in our process. It's really ensuring that we're asking all the questions, that we're not missing anything. It's about a 75 question checklist. And you can really see our investment philosophy coming through in the 3 categories that you can see here. So the sustainability of the franchise, management quality, as well as corporate governance. A bit of a more emphasis in terms of the weighting on on the franchise. But what this does is it results in what we call an overall score. You can see here, the example here is 87.4, which is essentially our conviction level in a company. So very important and will be pretty highly correlated to the weighting in the portfolio. So we do this checklist and we complete this checklist at the outset of investing with a company, but we also use it as a monitoring tool. So we're updating this overall score typically at least on a quarterly basis. But because of the long-term nature of the questions, we don't tend to see the score change significantly. But if we do, it could be a great reason for us to revisit that stock, to do a debate on that stock. So it's a really important step in the process. And then in terms of portfolio construction on the next slide and our decision-making process. So Phil is the ultimate decision maker for the strategy, but it's a very collaborative process. He is working alongside each portfolio manager throughout the entire investment process. So it would never be the case that somebody is working on a stock in India for 3 weeks or a month and then presenting it to Phil. Phil is working on it alongside that portfolio manager. And in terms of our portfolio construction, it's a relatively concentrated portfolio, typically between 45 and 50 holdings. That's been the case over the past few years, that we think that concentration and conviction is important. So we feel comfortable running a little bit more concentrated portfolio. But our position sizing is driven by, as you can see, conviction level, overall strategy, fit within the portfolio. So using things like our themes, again, to position the portfolio, but also valuation is a very important step in the process of portfolio construction.
And then when it comes to risk management, we do have a portfolio engineer that sits on our investment team. So we have the overall RBC risk management, which is very helpful. But what we found is having a risk person really embedded in the team has really helped us when it comes to portfolio construction, when it comes to buy decisions, sell decisions, where we're taking active risks in the portfolio. So James Bateson, who's our portfolio engineer, has, I think, added a lot of edge to our team over the past 6 years that he's been on the team. But we really think about risk management. What we're thinking about is business risk. So we want to be investing in very high quality companies. And as a result of investing in these high quality companies with lower business risk, we tend to have kind of a lower volatility of returns because of the type of companies that we're investing in. So maybe I'll pass it back to Phil and he can talk a bit about our characteristics.
Yeah, so in terms of characteristics, if you look at the chart on the top left, you can see, as Alyssa touched on, that we do have a high conviction portfolio, and that in recent years we've been consistently between 45 and 50 names. We also have a very long-term approach. Our average turnover over the last decade has been around 20%, of which half is trims and adds and half is new position turnover. So typically every year we will have about 4 or 5 new names. Now moving on to our country and sector weights, what you can see here is that in terms of sectors, we tend to be overweight the more domestic sectors. We've generally been overweight staples and financials that we feel really tick the boxes that we look for. In terms of staples, you tend to get very steady growth, good quality businesses, strong cash flows. And in terms of financials, what we found is that the very best financials, the best banks, the best insurance companies in emerging markets are really able to maintain their competitive advantage over very long periods of time. And that's exactly what we look for. We're generally underweight more cyclical areas such as energy materials. In terms of countries, what we've seen historically is that our most consistent overweight has been in India, and most consistent underweight has been in China. What we've seen more recently is that for the first time ever, we've gone slightly underweight in India, really driven by valuation. And also for the first time ever, we've gone neutral to slightly overweight in China. So for 15 years, we've been underweight. But in China, what we see is that valuations have become very attractive. The government is much more supportive of the private sector and of the economy. The government has changed its priorities. And as a result of that, we have recently gone overweight, and we've actually started to see China really outperform in recent months following quite a weak period.
Wait, Phil, one second.
We would say that
There's a question, sorry.
With respect to China, I sometimes view China as Hotel China. You can check in or check out anytime with your capital, but you can never leave. What do you comment on that?
You have to be very careful where you invest in China. If you look at China, as an investment over the last decade, it's been a pretty good performer actually overall compared to other emerging markets. But you obviously have had to be in the right stocks. It's been relatively weak in the last 3 or 4 years until the last few months. It's very much a case of being in the right companies. We tend to be very, very focused on management that we trust, on the right private sector companies, also on being in the right areas. A large part of the market in China is state-owned, and we generally avoid state-owned companies. We're very cautious there. If you're investing in a general emerging market strategy, you can't ignore China. China, was at its peak 43% of the benchmark. It's still around 30% of the benchmark. So, we feel that really being invested in the right stocks in China is the absolute key, and also investing at the right time. When China was very overvalued 4 years ago, we had a huge underweight position there. Does that answer your question?
Yeah, generally, we can go on. We can go on. Thank you.
Okay. So in terms of portfolio characteristics on slide 15, we would say perhaps the most important characteristic of our portfolio is its quality bias. And what you can see here is, thinking about ROE as a good proxy for quality, we've consistently had about 2/3 of our portfolio exposed to the two highest quintiles of ROE and very little in the bottom quintile. One of the things that we feel is very important is that stock selection is the real driver overall for our performance. And if we turn to slide 16, we've got a breakdown here of overall risk, and stock-specific risk is in the dark blue. And you can see that consistently we have had 60-70% of our risk coming from stock-specific risk, and that is exactly what we are looking for. I'm going to hand back to Alyssa now to touch on performance.
Yeah, absolutely. So in terms of our performance on slide 17, we're looking at excess returns, and our objective is to outperform the index by 3% gross of fees over a market cycle, which is essentially what we've been able to do. But in terms of the types of characteristics from our track record, there's two characteristics that are very consistent since we launched in 2010. One of those is downside protection, and the other is low volatility of returns. And you can see that illustrated actually on slide 20 if we skip ahead a couple. You can see every quarter of our track record, the yellow bars are showing quarters in which the index was down. You can see it all but all but 4 quarters we've outperformed. And really what those quarters have in common when we didn't outperform is that they were very much value-oriented markets. So not an environment where a quality manager would necessarily outperform. And then in upmarket periods, we tend to keep up with the index, outperform. What we saw was quite strong performance over the past few years. A lot of that coming in downside and down markets, but also in upmarket periods as well. And that low volatility of returns, I think, is well illustrated on slide 21. This is looking at our peer group using eVestment. We've been able to deliver these top quartile returns that we're proud of that. But I think if you look at the second column, you can see our standard deviation is at the bottom of the pack. So our risk-adjusted returns are sort of in that top decile in our peer group of emerging market managers. So I think with that, it's resonated really well with our U.S. investors, with our institutional investors, when we're thinking about a relatively riskier asset class. Having that higher risk-adjusted return, I think, has kind of, again, resonated well. Maybe before we open questions, I'll pass it back to Phil. Yeah,
maybe I'll just summarize what we would see as being our key differentiating factors on the next slide. So first of all, our focus on consistently high return companies, and as I showed at the beginning, these companies will be the long-term winners. Secondly, the blend that we have of top-down thematic and bottom-up research, and with these top-down themes, we're really able to position the portfolio in areas of long-term sustainable growth. Thirdly, our team, it's a very diverse team, works very well together, but also one that's very focused on research. And when it comes to research, we absolutely do not cut any corners. Fourthly, durability, the culture of companies is really integral to what we look for. And again, we feel positions us in long-term winners. We've touched on our low volatility and strong downside protection. And finally, we feel that conviction is important, and because of the research that we do, we're very comfortable running a focused, quality-driven, long-term portfolio. So thank you all very much for listening, and with that, I'm very happy to take any more questions that you may have.
I returned to your Tata group, and I must admit I hadn't necessarily followed it extensively. Didn't they even purchase Jaguar? I mean, and aren't they really a, quote, family-owned company, a large percentage?
Yeah, so that's a different part of that company. So that was Tata Motors, but TCS, Tata Consultancy Services, is a separate company, but it is part of the whole Tata Group.
And then when you have companies that may be sort of like more of a conglomerate, how do you tease out the items of interest or earnings and cash flow, or maybe you just don't invest in those companies? So a conglomerate type of scenario, could you address that just briefly?
Yeah, we don't tend to invest in that many conglomerates. So in the case of TCS, we don't invest in, you can't actually invest in the holding company. I'd say, where we do invest in conglomerates, it would be where we, have very strong conviction in the operating company, and we feel that the operating company really dominates, and we feel that management are very much aligned with the operating company. But it's not something we tend to do very often.
Thank you.
Okay, we have a question from Trustee Harris. Yeah.
For Tracy, I think, or whoever said that you guys are heavy in California. CalPERS and CalSTRS invested in your company?
Yes.
Little?
A lot.
That's okay. The other thing is looking at Taiwan and the change in the political climate politely in the U.S. vis-a-vis Ukraine and how that might impact Taiwan. Is there a defensive position that you take to prepare for what could be the loss of our high-tech chips?
Yeah, absolutely. Phil, do you want me to start and you can jump in?
I didn't catch the question.
Yeah, you'll hear when I'll still talking about it. So the question is about Russia, Ukraine.
Yeah, go ahead and answer.
Yeah, absolutely. So what's interesting, so with Russia invading Ukraine, of course, we did not predict that something like that would happen, but we saw a lot of risk with Russia. So we actually didn't have any exposure to Russia when that happened. We actually haven't invested in Russia, I think, since 2017 or 2018. But exactly right. There was a lot of concerns that if Russia can do that in Ukraine, is China going to do that with Taiwan? And what we saw is actually the reaction, the global reaction to Russia as a result of that invasion, we think actually scared China to some extent because Russia is relatively isolated. They don't rely on the global economy the same way that China does. So China and the US are still each other's largest trading partners. And the type of sanctions that came down were very severe, and China really couldn't survive that type of environment. It's also very unpopular in China for some sort of Taiwan invasion or inclusion. And what we found especially over the past few years, is that in order for the government in China to stay in power, they still have to be popular. So we saw that with the lifting of the COVID restrictions, there was a huge movement against that, and the government very quickly released that once it kind of got pretty bad there. So we actually think that it's kind of pushed out the risk of a Taiwan conflict overall. But it is something we're concerned about and something that we look at, but right now, not as big of a concern because of the reaction that we saw of Russia.
Well, one other thing I'd add in terms of the US relationship with Taiwan is that we're seeing two things at the moment. So essentially, we're talking about Taiwan Semiconductor, the largest technology stock in Taiwan. We're seeing two things at the moment that look relatively likely to happen. So first of all, TSMC looks set to take a stake in Intel, and secondly, TSMC looks set to build more factories in the US. And we think that in terms of both the risk in terms of trade tensions or tariffs on Taiwan from the US as a result of these two factors is substantially reduced.
Any other questions?
Can you talk a little bit about the research process that you use? And how often are you meeting with portfolio companies, prospective companies? Just kind of give us a sense about the research process that you're using.
Yeah, absolutely.
Yeah, I'd say we meet with about 500 companies a year. We do lots of research trips out to the region. And in terms of the companies that we own, we aim to meet management at least 2 times a year. We're very focused on longer term factors when we meet companies. So factors such as strategy, culture, long-term competitive issues. We do an awful lot of work before we actually meet with companies. We really do our homework. And I think as a result, management really enjoy meeting with us. It's very much a sort of two-way dialogue. So, for us, research meeting with companies is an absolutely crucial part of what we do.
I think it gives us a bit of an advantage as well being in London. So we do a lot of on-the-ground research, but London has become kind of this emerging market hub of investing. So a lot of management groups come through London as well. So we can meet them on the ground, but also in our office in London.
I've never heard the term portfolio engineer. Can you describe that job and what it might compare to in other companies?
Yeah.
I'd say it is quite unique to RBC, and in terms of how we use our portfolio engineer, I'd say sort of a couple of different things. So first of all, we feel that learning from data, continuously aiming to improve is something that's really important. And James will help us in terms of looking at a lot of data in a lot of different areas, whether it's our buying, our selling, our portfolio biases, our risk, our attribution, our portfolio concentration. James also gets very involved in the risk side of things. So we'll have regular meetings where he'll outline the biggest bets that are in the portfolio, what's coming from top down, what's coming from bottom up. You'll see a slide here just coming up. Have you got the slide that's got the 30?
Yeah, so
slide, 30 biggest bets.
Slide 38.
I think it's near the back.
Yeah, slide 38. It's a good illustration.
But perhaps it's a very good illustration of so here you can see the 30 biggest bets in the portfolio. So you can see at the top that we're getting 76% of risk is coming from stock selection. You can see the stock selection bets that we have. So Mahindra and Mahindra, HDFC Bank, Antofagasta. So having someone on the team who's focused on risk, rather than having an outside person looking at risk, we feel is a huge advantage.
Mm-hmm. And I would add a point to that. I've worked with many firms over the years and represented their emerging markets capabilities, and there's never been a portfolio engineer on any of those teams. And I'd like to think of that role as the advocate for the clients. He is pushing back on the portfolio managers and making sure they're doing exactly what they say they're doing. And so it's an embedded layer of risk management that I think is really a benefit to our clients. And we're able to do that because we work for such a well-resourced organization, very conservative and very open to ensuring that our clients' needs are met.
So in my mind, he serves more as a data analyst role as opposed to an optimization portfolio type of engineering. Am I correct on that, really?
I would say that.
Yeah, I would agree. I think it can be a bit of both, but I think you're exactly right.
As you know, we are invested in 91 and have decided to stay invested. What about RBC do you think is a nice complement to our current investment in 91? What's similar, what's different for us to consider?
You know, I don't have a lot of experience with 91. What I recall is that many of them came out of PIMCO to start that organization. And my counterpart recently left and went to join a new firm. I think one of the things that's most important for us is that in addition to having this strong expertise and having high conviction, bless you, with our portfolios, we also are equally tied to the communities in which we serve. And I don't think that 91 can make that same representation, not only globally, but locally. And I think also, having competed against 91 for a rather big mandate from one of the organizations you mentioned, one thing I was told was that the culture of our firm really comes through. There are no big superstars. These are like hardworking people who've worked for the firm for many, many years. It's not a new organization. We've been around for a long time, and having someone like Phil, who was there at the inception of this strategy, I think is an area of distinction that many organizations have not been able to emulate. I'm sorry I can't provide more detail there.
No, I know you don't work for 91, and I don't know if any of them have, but are your analysts and managers compensated by performance?
Yeah, I can speak to that. So in terms of our strategy here, so our portfolio managers, our analysts are compensated on the performance of the strategy as a whole, using kind of longer term performance as really the benchmark there. So we really want to ensure alignment of the whole strategy's performance along with our compensation. So while we have our teams, you know, if you look at it, we have a country coverage. We don't want to compensate people just on the stocks that they cover. We want to make sure that we're making all the best decisions for the total portfolio, and we think that that strategy of being compensated at the strategy level is a strong alignment.
The prior presentation, the question came up, succession planning.
Mm-hmm.
So could you address that, please?
Yeah, I can address that. So, first of all, I don't have any plans to retire. I'm expecting to be around for a very long time to come, and there's no pressure on us to retire. But we do have a very strong succession plan. My deputy is Laurence Ben Safi. She's been working with the team for 11 years. She previously was a head of emerging markets at Aviva. She's very experienced. She actually takes on a leadership role in a number of different ways already. She's actually on the management committee here at RBC in London. So although I don't have any plans to retire for a long time, we do have a very strong succession plan as well.
Quincy? Can you talk a little bit about country risk, just a little bit more, and sort of how you think about that? You know, given the index and, you know, concerns about China, Taiwan, just, you know, how do you integrate country risk into some of the cash flow metrics that you think about? Or are they integrated? I don't know.
Yeah. What we do with country risk is that where we feel risks are particularly high in terms of political risk or currency risk or macro risk, we then take that into account in terms of our portfolio construction. And we are, you know, we will, you know, be comfortable not investing in a particular area if we feel that country risk is particularly high. Alyssa touched on, I think probably the best example that we had was not investing at all in Russia 3 years ago. Now, we didn't predict the Ukraine war, but we did recognize the very high political risk that exists in Russia. So where we feel that these risks are unusually high, we are prepared to take a stance.
Chris?
Can you tell me a little bit about your ESG program or component?
Yeah, so for us, we've been thinking about ESG right from the start. We feel that in emerging markets, it's very important being in companies with strong corporate governance, strong management, companies that really think far ahead. And essentially what we find is that by thinking about this, that we're able to invest in companies that have a strong culture, a real culture of excellence, companies that think long term but don't take shortcuts, companies that have engaged employees, companies that don't take the same risk and therefore don't face the same problems as competitors. And we find that these are all factors that lead to higher and more sustainable returns.
Trustee Kelly?
Looking at your slide 7, the themes, and are your analysts constrained? Do you have analysts that specialize in each theme, or do they start with what they like and it has to fit in one of these?
Yeah, so in terms of the research, we have, so the team essentially is split by country coverage. And on top of that, people will do sectoral and thematic top-down research, but that is essentially rotated. So someone might do a piece on aspiration or on local brands or on deposit franchises. And when someone would do a piece of research on that, it tends to be a very detailed report. I mean, often 30, 40, 50 pages. There's a very long shelf life to these reports, with long-term in terms of that thinking, and essentially they tend to be sort of very comprehensive. But what we find is that by doing that, by pairing the country and the thematic research, we're really able to give everyone on the team a much broader perspective of the whole asset class. We can avoid biases that can occur from people being stuck looking at one area. And for us, it tends to promote discussion and debate.
Thank you.
As you're aware, we have had numerous companies come talk to us today, and it's almost impossible not to compare and contrast those companies. One of the major selling points that was driven home by the previous company was the non-benchmark companies that are included in their plan. Do you guys have statistics on which ones you guys have in your plan, and what percentage of your plan are non-benchmark companies?
Yeah, so on average, since inception, we've had 20% of our portfolio in non-benchmark companies. And what we found is that the majority of those non-benchmark ones have been smaller companies that are in countries that are in the index, but the companies themselves are not in the index. And we have found when we've looked at our overall performance, that our performance has essentially been sort of very diversified. So whether you look at it by country or sector or stock, but overall, one area that has definitely more than contributed in terms of overall value has been the smaller caps that we have had. So on average, we've outperformed since inception by about 2.6% a year, and the non-benchmark, which should represent around 20% of that 2.6, I think we've probably had about 80 basis points out of that 2.6 from non-benchmark companies.
And I'd say when it comes to those non-benchmark companies, it's frontier markets, it's companies that are emerging markets, but listed in developed market countries. But we want to ensure that the companies that we're investing in are truly emerging market companies. So that's very important to us as well.
And for your fund, it's typically 45 to 50 companies at a time. Is that correct?
Yes.
Okay.
Are there any further questions?
So you talked about not investing in Russia at this point, back in 2017. So in the current state of the world, what are you looking at for, are there any red light or flags that you're not going to invest in?
That's a great question. Phil, are there any kind of red flag countries that you're looking at?
I'd say there's no red flag countries, but we haven't invested in the Middle East and particularly Saudi Arabia yet. That doesn't mean we won't, but what we've found is that even though there's a relatively interesting top-down story, we've been much more concerned about the quality of stocks, poor corporate governance, poor management, state interference. So, for us, that would be probably the best example currently.
Yeah.
Okay.
More personal curiosity, since I went through my master's in statistics and I see the backgrounds. What does Lawrence CFA do with her background in statistics for you?
I'd say that overall we've got a lot of different backgrounds as a team, and in terms of the sort of whole diversity and the whole sort of way of thinking, that having that diversity with lots of different backgrounds brings different perspectives. So that would be one point that I'd mention. In terms of her statistics and quant background in general, it's actually incredibly strong. And one of the tools that we use in terms of idea generation is that we do have a quant screening tool. It's not a crucial part of what we do, but it is something that we look at. And Laurence has very much helped us in terms of developing that quant screening tool.
Thank you.
Okay, any further questions, trustees? All right. Thank you very much for your presentation.
I would just end by saying it's been a pleasure to meet with all of you, and we would welcome an opportunity to partner with you. We're a large, well-resourced organization with kind people dedicated to doing the right thing by our clients and living well and giving back to our communities. And I hope that we can gain your support. Thank you.
Thank you.
Thanks, everyone.
Thank you.
Safe travel.
Thank you.
Thank you.
All right. Thanks for having us. Thank you. My return. Thank you.
Thank you again.
Okay, I believe that we have some closing comments from Callan. Claire?
Sure.
Good candidates.
Yep, I would agree. Yeah, so two good candidates. Again, heard from Artisan first and then RBC. I guess I was writing down just kind of a couple summary notes. Yeah, go ahead. Oh, between Artisan, yeah, alphabetical.
That was Robert's doing.
Alphabet.
Yep. So yeah, landed on alphabetical order. There you are. But Artisan, again, run by a key portfolio manager. That's Maria Negrete-Grusin. You heard from her here. And then she's supported by 6 dedicated analysts, and they spend their time researching stocks to put into the portfolio. So Richard, again, to that bottom up, they're picking stocks to build the portfolio from the bottom up. fair amount of discussion of they're a little bit less benchmark aware, right? So they have more in their portfolio that's not in the index. They spoke to that directly. It's an all cap portfolio, higher allocation to small cap at times, and it skews growth. So if you flip to page 6 of that initial kind of summary presentation, no problem.
Are we on page 6 of which presentation? Yours?
The Callan summary presentation. Yep.
Getting there.
Yeah, that's it.
The style map?
The style map, that's it. So when we get there, you'll see here we just take each of the portfolios and we put them on this style map. So how they map from a growth value component, where the total portfolio lays on that spectrum, and then from a cap size perspective on the vertical axis, small cap to mega cap. And you can see 91, the existing emerging markets manager, pretty dead on in the center. A true core portfolio, that's what we're looking to complement. And then the artisan portfolio is the furthest to the right, so a bit more of a growth tilt than RBC or 91. And that's consistent.
Can you put up a comparative on an annual return basis?
Performance, yeah, that's 2 slides ahead. So here we break down calendar year performance for each of the 2 strategies we've discussed today, along with 91. Below that, it says Callan Emerging Broad. That's the peer group. So that's a peer group of other emerging market strategies that we're comparing these firms to. And then the last line there is the index, the MSCI Emerging Markets Index.
What I'm looking for is like how they both did over 10 years or 5 years.
Yep. Yep. 1 slide forward. As of the end of December, here's the quarter, year, 3, 5, 7, and 10 years. So what stuck out to me when I looked at this page of performance and the following page of performance and resonates with kind of the comments from each firm is, over the last 5-10 years, both firms have done very well. Over the last 10 years, Artisan has turned in a 5.83% return. The number in parentheses is the peer group ranking, so that's ranked in the 21st percentile of the peer group, top quartile. RBC returned 5.48% annualized over 10 years. That ranked in the 27th percentile of the peer group. So both have done very well over that time period.
It's a roller coaster versus the carousel.
There you go. So, and exactly right. So then when you look at the calendar year returns, the return pattern to get there has been very differentiated though. So RBC has protected in down markets more so than Artisan has, and Artisan has outperformed in up markets more so than RBC has.
Where is Artisan based out of?
They are based out of Milwaukee is where this team is. The U.S. team is headquartered.
Well, they said they had 70 employees in California.
A lot of California.
They do. The CEO is actually based in California.
Okay, do we have any other questions, or do you have any other tidbits to throw in?
Open to any questions that the board has, of course. I think those are my high-level comments.
At this point, I guess we'll go on to board member discussion. And to open the discussion, I guess I would say that I when I initially looked this over, I liked the style chart graph that you have on page 6 here. And I think what I've heard kind of complements what I thought, which is that if we really want a contrast, if we really want a company that complements what 91 does, Artisan seems to stand out and have a lot less redundancy with what we're seeing with our RBC. That's I think that was still something, if we're looking for contrast. Also, there's a big contrast in terms of one company is very much doing a bottom up. Artisan is very much starting with the bottom up, and RBC really seems to have a much more top down global economic approach.
Well, so I would pipe in and say that at least in terms of RBC, really that top down portion is not that significant. If you were to look at the holdings, RBC does do a better job in the back of sort of outlining their holdings into what regions or sectors by country they've got within the portfolio. But I think in terms of a complement, this is sort of one way to look at it. Slide 6. There are some other metrics that we can look at to determine that. And one of these is the behavior that we see on slide 8 between the returns. There's sort of that downside protection factor. So we could see that in 15, 18, and 2022, you've got this downside protection from RBC. 2021, maybe a little bit less so. But one thing that you can also see here is that the highs from Artisan, they're definitely higher than the lows from RBC. So I think as trustees sort of consider that, you want to notice that factor that's happening here on this page. And in fact, some of the previous Callan presentations have also shown that. It's not just style maps, I guess.
Robert, you, of course, took professional development with your recent professional test. What ideas from that curriculum do you think may be relevant here?
So this is a philosophy question, and my opinion and my philosophy is that downside protection is key for us. It should be key. And so I don't know if there's, in this summary deck, there's downside metrics, but I don't believe that's in this summary. But if we were to look back at the document from December, we can see some of those things like the drawdown statistics. The sort of the low volatility quality aspect of RBC is reflective of these returns that we can see on page 8 of the current Callan slide. For me, that's a big thought process. The other thing that I think about here is the benchmark that we're targeting, the MSCI EM. Artisan talked about how they don't necessarily believe that's the best benchmark for their strategy, and whether that's right or wrong or good or not is sort of irrelevant. But the fact is that they do have these sort of different exposures, a higher exposure to frontier markets. They're less concerned about the benchmark. Mm-hmm. So for me, my view is I sort of feel more comfortable with a strategy that is going to consider the MSCI EM strategy a little bit more. Now, RBC also has the option to hold up to 35% out of benchmark holdings. So they're not against being able to be outside the benchmark. They certainly can do that when they believe there's a good company that has cash flow metrics that they are interested in. So I sort of think about those two things as the benchmark, the constraints in the portfolio. I like that. I also like these drawdown metrics that, in my view, clearly favor RBC on drawdowns.
I would like to point out that they decades ago identified Taiwan Semiconductor, which is, in my book, quite impressive that their team had was early on that opportunity.
Trustee Shoemaker?
To that question, do we ask that of both teams? I mean, if you ask it of one team, they said, I was on board at day one. The other team doesn't get the answer. Okay. But I really appreciate your analysis about the downside. But we have a very conservative portfolio already. And if the roller coaster after 10 years has a better return than the more stable one, what is it you're looking for? How does everybody being down and one group holding it up better than when things start to cook? The other group, raises the bar and actually performs in a manner that adds more than the other group would over a long period of time.
Yeah, this particular portion of our portfolio would not be the portion where we would be looking for the least risk in terms of downside. I would think we have other portions of our portfolio that would.
One's like plumbing, so
This is where we're looking to hit a home run, I would think, or we shouldn't be in it at all. We're looking for massive amounts of growth, disproportionate amounts of growth in order to have large gains. That's how I read this portion of it. That's what emerging means to me. It's high growth. So yes, of course, you always want to have a less risky downside. You want to have as little risk or none if you can. But yeah, if you want to make money.
I felt the same way going into this conversation. The thing that I keep going back to is seems like Artisan is doing something quite different from the 91 that we're currently invested in and RBC. So there is the question of how do you complement each other, but there's also the question of this group here there's no overlap. So what are they doing that's so different? And when you look at the growth, I get it that is the intention of this, but I also have to ask the question that it is quite a bit different than whatever the MSCI and 91 and RBC. So that's where that risk, I think, continues. And I don't know, I look at analogies often, and it seems like I used a baseball one last time, and this seems like we're doubling our bets at certain tables with the potential of having a higher reward on that payout. But then I feel like we have traditionally played at the $5 blackjack table, and they might be at the $25 or $50 table with Artisan. That's my and the only concern I had throughout the presentation from RBC was it seemed a little bit of overexposure to China, to me personally, which is concerning.
Yeah, it just seems like RBC is replicating the benchmark, 20% off the benchmark, right? And so, and their fees are higher. So what are we paying for if, why wouldn't we just go with the benchmark and so I'm just looking at, if we're looking at growth, we want to be a little more aggressive, then it seems like you go with the lower fee and the returns are better over the long run.
So I would point out that the active share of both strategies is pretty close. So even though Artisan, was focused on that 40% versus RBC's maybe 20%, if you actually look at the differences in their portfolio with weightings and holdings, they're actually really close. It's something like 70 to 78%, which is, well within the typical active manager space. we would want to see that above at least 60. So
On that point, we just made a pretty drastic change to this side of our portfolio, and we went 63% index, right? Which doesn't have fees. So I'm not as worried about the fees personally, because we just changed it. We made a pretty significant change to this part of our portfolio to get rid of those fees. I may be misrepresenting that, but that's my opinion.
Can you just repeat what you were saying about the 70 and 78%?
that the active share measurement, which is a way to measure how different they are from their benchmark, is not very different. The difference between 70 and 75 or 80% is really not that much.
So they're both very active
Yeah.
strategies.
They're
Neither
both
one is,
they're both active.
you know, a closet index strategy for.
To me, it was impressive that Artisan had identified Taiwan Semiconductor decades ago. I mean, in that sense, of course, you know, one example is sometimes a little hard to weight, but to me, that type of forecasting speaks well for Artisan.
I'll tell you about my home run, but it was literally just throwing something at the bulletin board how I picked that one. But I would like to perhaps give you a different perspective. As a plan that is maturing, the plans become less able to absorb those shocks in the market, especially if they are sustained for a period of time. So the potential downside volatility in the long run could be an issue for the plan as we continue to mature. It's not necessarily an issue today, but we are on the mature side of plan, both demographics, including cash drawdown and things of that nature. So that's one condition that the board should continue when deciding how much growth tilt do you want, how conservative do you want. Is just that the plan as a whole, when it is becoming more mature, has less resiliency to bounce back from those negative events.
I still sort of, and of course I'm without the comparison, but it seemed like Artisan downside didn't differ too much from RBC's downside returns. That was my general impression, but I didn't do the calculations.
It is significant.
It is, yes.
It is significantly different. The downside's like 94 to RBC versus 110 for Artisan, I think. 112 to 94. So it is significant. RBC has lower risk metrics all around. In terms of return stream correlations, they're basically both zero. So they both are uncorrelated with 91.
Just another part of this, and I don't know how it correlates to what this RBC is doing, but the county just divested from RBC because of their investments in oil and gas and everything, and so I don't know what this how it correlates to it,
And
but it will be a sensitive issue for a lot of people, I think.
I would like to chime in there. The investment the county had, I think, was a bond in RBC itself, and this is a investment in an emerging markets fund that RBC does happen to run. But the fiduciary aspect of sitting on this board is that you wear only one hat at a time, and you're making the decision that is best for MSERA in that regard, and not necessarily taking direction from the county or other entities. And Jeff can chime in if I've misspoken there, but it is important to consider that this is not the same type of product. It is not necessarily a bond investment within, of RBC itself.
So I'll just add to that, because you brought up fiduciary duty. At least until this most recent discussion, I'm thinking this is a classic great process for satisfying and meeting your fiduciary responsibilities. You know, you have your outside consultant, your inside consultant, you have the folks come in and give presentations, and then you ask a lot of great questions. So that's like classic, great process for meeting your fiduciary responsibilities. The issue of divestment or that type of thing, it really, like Doris is saying, it really needs to be driven by returns ultimately. So if you can have your cake and eat it too, and you know you're still meeting your investment returns, that's great, but the primary emphasis must be on your returns.
I would say it would be fit for the portfolio and not solely a consideration of return, but I get what you're saying.
And I just would like to clarify, the county fully isn't divested from RBC. We still hold funds for another few years. And we do have the safety, liquidity, and equity mandate. And they are two separate functions of what the county holds versus what we're looking at right now.
I don't think there's a bad choice here. I think either one of them are defendable depending on your skew or your viewpoint. I, based on the feedback I'm hearing, believe that Robert and Doris are both leaning towards RBC from the feedback I've heard. I haven't heard from Callan. So do any of you have any strong feelings on the presentations we just saw or recommendations of our overall portfolio or this aspect of our portfolio? What you think, which one would fit our needs better?
Thank you.
Me first?
Totally three under the bus.
Yeah.
You're closest.
It's true. I first off, I do truly echo the sentiment that I think both are good choices. I think I do like the downside protection of RBC. That portfolio performance pattern seems easier to hold on to through cycles, but for me, it's splitting hairs. I like both strategies a lot. I like the teams, and I think both have truly turned in excellent performance results, results that we would have been happy with if we had held them for the last 10 years with 91.
And I agree with that. It's not that one is significantly poorer than one of the others. As Callan has pointed out, they're both good options for a complement to the manager that we currently hold. Charlie?
Anyone else?
The firm with which I'm associated has artisan funds in their aggressive portfolios. If it was, and it is my money. Very often, I put my money on artisan, but I'm an aggressive investor. I think if a portfolio wants to have an aggressive piece, artisan is it. If you want to have a consistent piece, RBC is it. It seems to me that in the last, since I've been on the board, there's a systemic need for comfort. Volatility hurts, and if you have to explain volatility to a potential retiree, that's painful. Why did you have this in the portfolio and it dropped 27% in a month? Well, because a year ago it went up 50%. Given that it doesn't appear that we're looking at a big chunk of dough for this particular thing, my vote would be for artisan for this portfolio need.
Can you remind us, what is the overall percentage that they would be holding of our portfolio?
3.2, 3.3.
Something percent of 25%.
24 or 25
Trustee
million.
Shoemaker.
3%.
Patiently wait.
3.25.
50% volatility wouldn't make a bit of difference.
One of the numbers that was in the RBC report was their performance net of fees and net of the benchmark over 10 years, and it was 0.87. And I can't find it in Artisan, but I have a feeling it's significantly higher or higher. And if people, you know, I learned this a long time ago, it's like what happens in the next year or 2 years really can set the pace for what's farther down because of compounding. You go up 100%, and next year you drop 50, or you drop 50, and the next year you go up 100. It's a very different number.
You did even.
And so we didn't ask any questions about how either of these guys felt about the future, which just came to me. You know, if one of them said, I think this market, you know, it's all a guess, right? But to me, the artisan program is the one, you know, again, I am here to personally pick it for him, Sarah, not just myself. And I think we have plenty of stodgy investments, so to speak, I think. And it is so minor, it's pretty incredible. But the opportunities, again, back to the word emerging, I thought the same thing before you said it. There's something about that word, and there's something about growth. And in the right company, in the right places, it could be phenomenal. All you gotta do is look at some of the crazy stuff that's happening right now with some growth stocks of even in different sectors. But anyway, when it comes, I don't know if anybody wants to make a motion. I'll start with a motion. Unless people want more information, want to get back to these guys, and I'll ask them what their predictions are.
Well, before we go on to the motion, first of all, is there any other discussion? And is there any public comment at this time? Okay, so at this point, it would be the portion where we ask for a motion, and the motion is fairly simple, one or the
I
other.
would move artisan.
Okay, we have second artisan. Is there any additional discussion? The board would like to take. The motion on the floor is to move artisan.
I would just like to chime in. I know I don't get a vote normally, but.
Sure.
Oh,
It's okay, go ahead.
sorry. But if I were to vote, I would vote for artisan, but.
Is there any other discussion before we take a roll call vote on artisan?
One more comment.
What?
I have no problem.
I think we need to.
Somebody says I told you so. Sure. Can we take a quick pause?
Well, this is an awkward pause. I don't know if we're allowed to actually talk during this meeting.
It's our meeting.
We could just take a break
I think that's a good
and
idea.
come back in
5 minutes.
when the big hand gets to the 8 at 20 to 12. That's a
10-minute break.
10-minute break.
We're on mute, right?
Share.
24-hour violation so that it didn't show a little red mark there, but it should not have broke anything. I think it just confused somebody.
You start to
Let's get this
recognize
started again.
how things translate into real life.
I keep sending my sister.
Okay, we're coming back to order. We're live.
Okay, we're live. Thank
Thank
you.
How are you?
Just to refresh everyone's memory, there is a motion that has been seconded to select Artisan Partners. And we're at the portion where we have a discussion about that motion.
So back to the question I had about, that we didn't ask them, I guess I would ask Callan, in your work on this project for us, I'm sure you have looked at the 2025 version of emerging markets. You guys have an opinion if they're better than they were or going to get better?
1 year outlook for emerging markets.
Make it a 5. I don't know, whatever you want. Make it 6 months.
I mean, Greg may have a good outlook.
We think there is a return premium in most risk factors, whether it's credit, volatility, emerging versus developed, international versus U.S. We believe there should be a return premium that you can earn by investing in a risk premium like EM. Over the long run, though. Yeah. Over the long run. And that's been the hard part with EM. That long run keeps getting longer. Yeah, that's a very rational approach to think about allocating capital. And as was alluded to earlier, you know, this is about a 6.5% or 7% allocation of the total portfolio to EM. Each manager is about 3%. So they are, you know, they're meaningful contributors, but the amount of exposure to the emerging countries is very reasonable.
And Greg mentioned that we believe in the premium in emerging markets, small cap, you know, those risks should carry a return premium over the long run. And I think importantly that resonates with the new structure that you're moving to as well, right? You're allocating your active risk budget in those areas, emerging markets and small cap, where we think active management can really pay off and where you've seen that in your portfolio over time.
How long are we going to engage the managers then? What's our time frame? Can you remind me?
We do open-ended evergreen contracts. We have no specific term for any manager contract. And some of these managers that are in our portfolio currently, we've had for a very large number of years. As long as they're meeting their mandate and have acceptable performance, we're not looking to change out of a manager.
No, yeah, we like to think that every manager's on watch all the time. So that's why we're reviewing the portfolio on an ongoing basis, reviewing each manager on an ongoing basis.
Trustee Haschak?
Well, from my point of view, it's like if all things are equal, more or less, you know, we're looking for growth from this sector, and the points are lower, the fees are lower for Artisan. I would say, why don't we go for Artisan?
So I would say one more thing on this. In my research about these two managers, if we were to have held them in roughly equal amounts since we've had 91, if we would have went with RBC, we would have had a 20 plus basis point. Now that may seem small, but it is 20 basis point higher return than we would have had with Artisan. So that's backward looking. I get that. But, you know, just because something has a higher return doesn't mean that it's necessarily going to pair and produce a higher composite balance for us.
But that is a point-to-point comparison, which is highly dependent on that first point.
It is a period comparison, and you know we could look at 300 different data points for 1, 2, 3, 5, 10-year different periods, rolling and fixed.
A question to that: it's in these documents what their 10-year performance is, right? If we put them up on the screen, what is the difference net of fees?
So as of the end of December, gross of fees, the difference was not quite 40 basis points, for 35 basis points.
For
Artisan.
Okay,
and then net of fees would be more like 55 basis points, 20 basis points.
So was it 0.95 for Artisan? Was it the fee?
Artisan is 65.
Yeah.
RBC is 84 with expense cap.
Okay, so it's that. 20% difference.
20 basis
Value.
points.
Yeah, well, between them, right?
65 and
25%
85.
between them. One is 20, one is 33% higher than the other. Yeah.
Which will stay at that level because of co-founders too.
Yeah.
But wasn't it something about RBC that it was 85, but then they tacked on another 14 or something?
So 84 is
Yeah.
inclusive of that expense.
Oh.
Yep.
Yeah, it was 74.
I will say this
70
math
plus,
may be
exactly.
wrong, but I went to the one point on RBC that gave their, how they beat the benchmark in 10 years, it was 187. And if I took the numbers right from Artisan, they beat the benchmark, depending on which one of the emerging markets they're using, 1.25 or 2.25. Not 0.87, but
And so I would make it even more complicated and say, just by the fact that Artisan admitted that they don't think the MSCI EM benchmark is their actual benchmark, right? That's actually not a good comparison for them. So,
well, all I'm
oops,
doing is trying to
you
put
know.
stakes in the ground to compare the numbers each group has based on return.
Yeah.
And if they're both putting it in their document, MSCI, the amount of the MSCI, if they like it or not, they put that stake in the ground as to compare it.
Yeah.
They might not be comparing themselves to the benchmark, but we can compare them to the benchmark.
Certainly. I guess the point of that is, as long as we're acknowledging that there is this higher level of risk associated with Artisan here. That's
I believe there is a high, I think that the numbers show that in the past there was a slightly higher number of risk based on down years. That's not necessarily looking forward. I think that what I like about Artisan is a couple of things. They did seem to be a little bit further from the beaten path, and I think that's what we're looking for. And they don't seem, they're not overweighted in China. And I'm a little concerned about China. I have heard, anecdotally, I've heard things at Sackers and what have you, major investors completely staying out of China. Now, I'm not saying that that's a good strategy, but I came into this discussion after reviewing these items, and I really thought that RBC would win. I thought they were going to be, after this, I thought they would come out on top. After listening to both of these presentations, I feel like Artisan is the better choice, and I intend to vote for the motion. Trustee
And
Harris?
I'll say why I'm going to vote against it, and I'll probably be by myself. But I am the risk person, and I have been to China. I went to the Global Pension Forum, CalSTRS. We went, CalSTRS and CalPERS, to study emerging markets. It was 2.5 weeks, most of which was in China. The last 5-6 days were in Vietnam. I see Vietnam as a very credible emerging market, even though it's been several years since this all took place. I've worried about risk in our portfolio, and we've gone along a separate avenue. Emerging markets, if you go to a place like Vietnam, and I will apologize for stepping on toes, but you look at utilities, for instance, in the way that even downtown Saigon, the utilities are, if you get new people coming on for electricity, they just hang another wire. So from pole to pole, massive numbers of wires are just hanging out there. I saw tremendous opportunity in Vietnam, and I do know at that point there was some opportunities to get on early. I'm listening to our staff, and the presentation, and I was leaning Artisan initially, but I am going to vote for RBC. After that, stability, the fact that there is apparently a California CEO, there's an ESG component. I think there's opportunity with RBC.
If I can chime in, because it sounds like everyone is, you won't be alone. I'm not going to vote for Artisan, and it's the downward protection that concerns me. When they're good, they're really good for Artisan. When they're bad, they're undefendably bad. I can't. And I get it's a small portion, but to me, the risk isn't worth the reward, so I will not be voting for them.
I do remember part of their presentation where they had the one down year, I think 2014, and they really snapped back, and I think they looked at their approach and tailored their approach to the lessons learned.
Are there any further comments? Okay, I guess at this point we'll call for a roll call vote.
Mr. Kelly.
Aye.
Ms. Cavness.
Aye.
Mr. Haschak.
Aye.
Mr. Cromer.
No.
Mr. Shoemaker.
Aye.
Ms. Harris.
No.
Ms. Pierce.
No.
Mr. Land.
Aye.
Approved.
Not unanimous.
Okay.
That's the board is all about.
Next on the agenda, we have the quarterly investment performance report summary. Go.
Yeah, can I share?
I can't hard time getting what I want.
Oh, I didn't know. Let me
Summary, right?
Yeah.
Summary.
I'm gonna jump to slide 17 to look at plan performance.
Sorry, it's just slow, Robert.
That's
It's all right.
If I had known, I would have done this.
I have to join too.
Okay. You should be good to have this.
Okay. 17.
Okay, thank you.
Proceed without him.
So the top chart looks at total MSARA plan growth as of the end of 2024. The chart at the bottom looks at the last 2 quarters, so fiscal year to date. As of the end of December, total plan ended at about $740 million. That was a slight pullback from the previous quarter. We saw mixed performance in the 4th quarter, but over the course of the fiscal year, the plan is up. It has actually recovered the losses it experienced in the 4th quarter in January of 2025, already year to date. So year to date, the portfolio is up 6.4%, fiscal year to date. Jumping to performance on slide 27. This looks at the total fund performance in each of the individual asset classes. In total, the MSARA portfolio was down 1.8% for the 4th quarter, trailing the total fund benchmark by about 41 basis points. For the last year, the portfolio is up a healthy 9.6%. Looking at just the last quarter, what's driving that relative underperformance is coming from your domestic equity. Domestic equity was up 1.2% versus the Russell 3000 index, which was up 2.6%. So that underperformance is coming from your small cap and mid cap managers, which underperformed the broad large cap market for the quarter. International was a tough quarter, but both international and fixed income were down, but close to the benchmark. And then MSARA's infrastructure and real estate funds were additive to performance for the quarter. We actually saw positive appreciation in real estate this quarter, which was good to see. Yes, it's been a long time. Are there any questions on performance for the quarter or longer term time periods?
I think time today was well utilized
Yes.
on the investment manager search. So as a headline to performance, we don't have any concerns other than those that are already being addressed. So.
Okay. Is that handling both the full report and the summary in that case?
Yes.
Okay. So next we go on to the quarterly real estate update, or do we take public? I don't have a list for public comment here, but we will.
You can do it at the end of the.
Okay. If a member of the public wished to comment now, we would oblige them. Okay. So that's Mr. Revelis.
Trustees, you have the quarterly real estate infrastructure report. I'd be happy to answer any questions, just the typical narrative. There is the addition of the locations for the Barings buildings on a map of U.S. Well, I should say Barings and Reef, right? Both managers. We've got a couple of those slides. I'd like some feedback on that. Was that good? Was that okay? It's a little bit stale dated.
I liked it.
That's for Trustee Land.
Yes, I liked it because the northwest, east, south designation makes absolutely no sense to me whatsoever, because I don't know where the lines would be. Mississippi and
Yeah. And I also changed the descriptor of the north, what I was previously calling north to Midwest. Without being too rude to all the folks that live in the United States, we've got the two coasts, the south, and whatever else is left. I was calling north. That's the Midwest, kind of the Rust Belt area. So hopefully trustees find that helpful.
And we'll look at probably including those maps annually.
Yeah, that's another point. We probably only show that map once a year, unless trustees want to see it more often than that. Twice a year, maybe.
there was some, as I looked through this, there were some big sales that had happened, I believe. Can you comment on those? And I can't remember exactly where I saw that.
Well, so Barings has basically repositioned their portfolio now almost entirely out of the office subsector. So that's been a function of their willingness to write down the properties. That way they can actually complete the transactions. So I think that's the biggest take away from Barings' side is that they were willing to write it down. They sold the assets, so they've sort of successfully pivoted to being office light at this point. That's the standout that I remember.
Is there any questions for Robert at this time? I guess. Did you have more?
No, that was it.
Okay.
Just an observation, Barings occupancy graph.
Yeah.
Yeah, because they got rid of all of that.
Yeah.
It's like, that is disinformation.
I believe Robert called on both items for the infrastructure too, and I just like to continue the narrative I've brought up numerous times that we get pointed out when we're wrong regularly, but I think that the infrastructure investments we've chosen are doing what we've intended for them to do, and why not celebrate that?
There you go.
The only criticism that I would make, at least towards IFM, it's not fair, I haven't said this to them directly, but, the fact that they're not spitting off any income to us, I'm kind of like, hey, what the heck, guys? JP Morgan spits off a lot, 5-6%. When they were here in 2019, they told us 6 to 10%, and IFM said the same thing. Well, now it shoves, that IFM is basically at zero on a trailing 12-month basis. That's not to say they didn't give us we didn't get anything back. That's just to say that they haven't gotten anything back to us in the last 12 months. So
those would be dividends?
well, that would be income. Yeah.
Okay.
Yeah. So, they told us maybe 6 to 10%, and right now we're going through a slump of 0. So, still a good strategy. I don't necessarily have concerns, but, every time I update that workbook and I see it's getting low and then it goes to 0, I'm just sort of like,
So when they dumped all the offices, did we suffer a loss? They wrote them off?
No. So there was 2 quarters of significant, I want to say it was December of last year, 11% loss. That was a huge one. And 2 quarters prior to that, there was I want to say at least on bearings, it was maybe 6%.
So are they banking on it? They're banking these losses and handing this out?
They already did. Yeah, they already did. And Reef was in the same position in those same 2 quarters, though the losses weren't quite as large. Reef still experienced, I want to say they were 5 or 6% in 2 quarters of total losses. So both funds experienced the same thing. Reef didn't necessarily have the same strategy. They weren't necessarily overweight office where they kind of had to make such a strong pivot like Bearings had to. Yeah, so those losses are already reflected in the return numbers that we are looking at for the quarter today.
Well, the board is aware that no money has been coming in, as we are now.
Yeah. It's definitely something that, when I talk to them, I'll mention that. Yeah.
Okay, is that it for C and D? Or, no, I'm sorry, for E and F?
That's all I have to say.
What about preliminary monthly investment performance report? Is that also something you're going to?
That is also here for trustees' review. You can see the quarterly returns, or the monthly returns, excuse me. We pulled a little bit of money out of the S&P 500 index fund just for operations, and I'd be happy to answer any other questions you have.
Are there any questions?
Was January's ending value a high watermark for us?
Yeah. We're at high water marks now. Yeah.
Yeah, I did notice that.
Mm-hmm.
So, nice number.
Yeah.
Is there any public comment?
There is none.
Okay. Then let's move on to item 6. Fiscal year, oh, wait a minute, did we do that one too? Did I have a straggler? Okay. Fiscal year 24-25 second quarter budget update. Thank you. Budget update.
Thank you. See you next month.
Trustees, you have the quarterly budget update report with the typical narrative and reports. I'd be happy to answer any questions you might have.
Does anybody have any questions about the budget report? Okay, no discussion or questions, and is there any public comment? Okay, item 7, board policy review. Doris Rinchler, Executive Director.
Thank you, Chair Land. There are 2 policies being presented for the board's approval today. The modifications to the policy are relatively minor. On the placement agent disclosure policy, primarily the changes consisted of updating some of the language within the policy that references a specific government code section to verbatim match the government code section. On the other policy, which is the separate accounts administration of divorce benefits, we added a paragraph to discuss how we determine whether or not a particular pay period is included or excluded from the period of the community property portion of the marriage. That's just simply a policy decision, and those policies are provided for your review. If you have any other edits to it, we can accommodate those, or you can approve them as presented.
Do we have any discussion or comments on these two items? I had one comment, which was going to be a question, but I think I finally answered it, that the member does not have to be married for the entire pay period for the contributions and services to be divided. And in the previous sentence to that, it says the member has to be married on the last day of the pay period. And it took me quite a while to figure out how those two things could not conflict. The only way I could think of was that if you were married at the beginning of the pay period and then got divorced at the end, they would count the entire pay period. I finally did figure it out, actually.
So when we start the marital period, let's say they got married on November 25th, but that may be, 3 days from the end of the pay period. We're going to include the entire pay period in the division. Now, subsequently, someone gets divorced on November 25th, we're going to exclude that entire pay period because they were not married on the last day of the pay period. I think I could have done a better job of ordering those sentences, because the relevant piece is that the marriage has to be intact on the last day of the pay period for that pay period to be included, and we are not prorating any pay periods. It's either included in the marital time that's being divided or it is not.
Thank you. Yeah, it took me a little bit of time to get there, but I got there.
As a matter of order, does it have to be, can it be one motion, or do they have to be handled separately? I'll move approval of the placement agent policy and the separate account community property division policy as presented.
Oh, roll call, please. Thank you.
Mr. Kelly?
Aye.
Ms. Cavanis?
Aye.
Mr. Haschak?
Aye.
Mr. Cromer?
Aye.
Mr. Shoemaker?
Aye.
Ms. Harris?
Aye.
Ms. Pierce?
Aye.
And Mr. Land?
Aye.
Approved.
Item number 8, administrative report. Doris Rentschler, Executive Director.
Thank you, Chair Land and Trustee Cromer. Just as a reminder, trustees need to complete a Form 700 filing for calendar year 2024 by April 1st, and you can provide that to Judy. We are working on the agreed upon procedures, and we have engaged with our consultant to establish a risk universe and the initial audit plan, and I'll be discussing that further with the audit committee, but we do hope that we'll bring forward a candidate for board approval and that the contract and audits would start with July, so the next fiscal year. As far as administrative matters here at the office, the recruitment for our vacant Retirement Specialist 1 position is open now, and we hope to have that position filled. So we are making let me back up and just say, all right, we did send out the 1099 tax documents for retirees. Those went out in the middle of December, well before the middle of January, my apologies, well before the January 31st deadline. So I wanted to thank staff for getting those out timely. Those tax documents are also available to members through the Member Direct portal. And we also sent out account statements. Account statements are also available via the Member Direct portal. We do a mailing. It's going to be once every 3 years. This helps us track down folks who may have moved and not notified us, especially if they're no longer obviously an active employee with one of our plan sponsors. And we therefore can find out if the address we have for them is any good and make efforts to track down folks who have moved for and are no longer employed with us. So we do have those documents available on demand 24/7 through the member portal, and I just wanted to make sure that our members and our trustees know that those documents are available through there. The Spring Sackers Conference is coming up in May. It's going to be at the Omni Rancho Las Palmas Resort and Rancho Mirage down south in the Palm Springs area. The conference hotel books up very quickly, so if we have any trustees who are interested in attending, I would encourage you to let Judy know right away. And the other item that I would like to receive direction on potentially from the board has to do with the landscaping. As you may have noticed on your approach to the building, several sections of the landscaping were disturbed by the recent construction for the ADA accessibility upgrades with the replacement of the sidewalks and realignment of some of the ramps. So we do have a quote to restore the landscaping that was damaged, including the irrigation system, the timers, and the plantings, including adding some gravel as ground cover. So the estimated cost for that is within funds that are budgeted for the construction overrun contingency, and we would plan to use funds budgeted there to restore the landscape back to an acceptable visual appeal. And if you have any questions regarding any item, I'm happy to address any questions you have at this time.
Questions?
So
Okay.
did you get the direction you wanted on this item? And I was actually going to mention, it looked like maybe you wanted some direction on the auditor contract as well.
Actually, I'm going to talk with the audit committee first, and then well, I take it back. One of the questions I was going to ask the audit committee, and we can also address it, is does the board actually want to receive the contract for approval for the UAP auditor? That's the agreed upon procedures audit. It is not our financial auditor. Our financial statement auditor contracts are reserved for the purview of the board. This is not that one. It could be delegated to the committee and or staff, but since this is the first time we've done those internal type UAP audits, I wanted to know if the board wanted to take action to approve the contract after we complete the RFP process. Then the second part of the direction would be whether or not to proceed with the estimate we received for restoring of the landscaping. And I believe we had a comment from Trustee Swope.
Given it's the first time, I think it may be useful for the entire board to see it, but that is the contract for the agreed procedures.
I would ask Trustee Pierce, is that something that someone like me would need to read through?
I think it would be beneficial for the entire board, but I'm on the audit committee, so I don't want to.
We do use basically the county standard contract with a few modifications for it, but in addition to that, the contract, when it's presented, would include like the scope of work and the audit plan, which will have already gone through the audit committee, but it might be nice for the board to know what the specific audits are. It would be planned for a 2-year contract, and we outline the audits that would be performed over the 2 fiscal year period. But that information would be included as exhibits and in the scope of the RFP that would come to you as part of the contract.
Okay. Sounds like there's no reason not to get it. So I think the general direction would be to receive. As far as the landscaping seems a little pricey, but it cost overrun. It's a reasonable use of those funds, and I would say it's probably in the best interest of the property value to do that. 10,000 something.
That includes replacing the irrigation system that got chopped up, and reestablishing connection to the timers where those wires were cut, and then including plants, which includes the planting along the back part of the building, plus updated planting along the front and the side over here where the majority of the work done, and gravel covering to help retain moisture. So those would be the primary aspects. We do have a very detailed cost estimate, but we are looking for approval or direction to continue with the landscaping. We aren't looking at doing full landscaping, so any area that's currently not disturbed, those plants would remain. There wouldn't be any new plantings added, but we can switch. We wouldn't necessarily be adding barrier there either, but we can certainly look at going with a bark mulch instead of gravel, if that would be the direction preference of the board.
Yes.
If you do gravel.
Yeah.
Okay, we can certainly look into that.
Yes.
What about small river rock?
Just non-flammable.
Well, river rock.
Right. Any other issue?
Right. But if it's a larger one.
Okay, not wanting to actually do landscaping design here.
I would rather just give
Sounds like we're getting into the weeds a little bit.
direction to staff to proceed as they see fit with the quote.
Yes, I would agree.
We do have a monthly service agreement for maintenance of the landscape.
Of the weeds, okay. All right. It sounds like we had our board discussion. Is there any public comment? And there is no recommended action. Do we need to have public comment on that?
You can take public comment with every item.
All right.
There is no public comment.
All right, there is no public comment. At this point, we go to general board discussion. And I do have an announcement that I've been asked to read. The audit committee is meeting on Monday, February 24th at 10 a.m. in McSara's conference room, right here at 625B Kings Court. And I will not, unfortunately, be at that audit committee meeting. And is there any other board discussion?
Well, I'll just say I'm excited to be on the board, and my history is 28 years in the classroom, and so I'm a recipient of STIRS, and that's very important. You know, defined benefit programs are crucial in this day and age. And when I was a teacher, I used to teach, other teachers how to supplement their defined benefit. And so I'm kind of, there's a lot for me to learn here, but I do know some of the basics. Yeah.
Anyone else? Okay, I guess we move on to closed session now. Item 10. Okay, we back?
On the closed session item, the board gave direction to staff and council.
Okay, that brings us to item number 12, adjournment and notice of next Board of Retirement meetings. The next Board of Retirement meeting will be held in the Mendocino County Employees Retirement Association Boardroom, 625B Kings Court, Ukiah, California, on Wednesday, March 19th at 8:30 a.m. And the meeting is adjourned at 20 to 1.